Successful manager, smart investor, nice guy. Who do you want to be? You want to have the knowledge and intuition that always gives you the advantage. Do you want to have at your fingertips access to the latest technology that lets you be one step or even a few steps ahead? To have stories of all of your victories and defeats, but always take lessons on how to improve. To feel the emotions, the excitement, because in the end, you see your strategy is working. Do you want to be like me? You can when you trade with XTB.
Welcome to XTB's online trading masterclass. My name is Caroline Rundell, also known as Trading Angel on social media, and I am going to be your host for today. So for those of you who don't know, XTB Trading is one of the largest stock exchange listed Forex and CFD brokers in the world. They provide retail traders with access to hundreds of global markets and are regulated by several financial authorities worldwide, including the Financial Conduct Authority. So right now, as you may know, it's a very interesting time to be trading the financial markets. There is a lot of high volatility with the ongoing Russia-Ukraine conflict, as well as rising COVID cases in China. So we think you are going to get a lot of value out of today's masterclass. We have a busy day ahead with 5 hours of educational content and 7 speakers. Obviously, you don't have to stay for the whole thing. Feel free to come and go as you please, or only stay for the parts which interest you the most. XTB are going to be recording the whole thing, and account holders will have access to the recording. So if you'd like one, then make sure you open an XTB account. So it's looking like a really interesting day. We've got speakers discussing stocks, CFDs. There'll be a specific section on commodities and also how to trade in times of geopolitical tension. There'll be a roundtable discussion on social media investing. The WallStreetBets founder, Jaime Rogozinski, is going to be sharing his incredible story, as well as how to build a stock portfolio. Plus, there will be a final speech on inflation and central bank policy. Today, we start with Stephen Clapham, who is the best-selling author of The Smart Money Method. Welcome, Stephen. I will let you introduce yourself in more detail and kickstart today's event.
Well, Caroline, thanks very much. I'm really excited to be here. I'm looking forward to the event. So why don't I just kick off and start my presentation? So the disclaimer we've already seen, but I'll give you a second just to read that. I'm a former. Oh, right. So we're good. Sorry about that. I think there's a bit of a glitch somewhere. So I'm a former partner head of research at two multi-billion-dollar hedge funds. I set up a training business behind the balance sheet in 2018, and now what I mainly do is help investors improve their performance. My main business is training professional investors. You can find me here. The website's behindthebalancesheet.com. You can find me on Twitter at Steve Clapham. But we also have, apart from training professional investors at some of the largest institutions in the world, think Schroders, Fidelity, Legal & General, Wellington, Bailey Gifford, etc. We've got an online training school. And you find that at behindthebalancesheet.com, all sorts of courses about how to improve your investing performance. And, these are really worthwhile things to do. I think many investors don't spend enough money giving themselves proper data, don't spend enough money educating themselves. So you can find that behind the balance sheet. But we also have a lot of free resources. I'm not here just to sell you stuff. We do believe that education is very important. And so there's lots of free resources. So I've got a YouTube channel. You can find that. It's YouTube /C/behind the balance sheet. We have a podcast. We just dropped number 8 with Chris Wood, who is probably the best strategist in the world. So if you're interested in macro, you really want to listen to that, because Chris Wood has been voted #1 strategist in Asia for the last 20 odd years, every year except one. And shortly coming out will be a free newsletter that will be starting in a couple of weeks. So make sure you sign up on the website. And as Caroline mentioned, I have a book, The Smart Money Method. So if you're interested in all this, worth reading. What I'm going to do today is I am going to explain the methodology I used when I was at a hedge fund to determine if a stock was worth investing in. And this is the advert. What we're going to do is this first pass financial profile method for evaluating trade ideas, spotting potential frauds. And I'm going to talk a little bit about why the hedge funds that I worked at use CFDs. So what is this FP squared first pass financial profile? For each company, what I would do is walk through the balance sheet, look at the cash flow, review the key P&L trends and key ratios. And what I was trying to do was to understand the basics of the company's finances, the trends in profitability, the trends in capital intensity. And what we've done is we've created a set of courses for the big tech stocks in which we go through all of this so you can understand the process that I go through. And in the courses, we supply a model, and we also go through the valuations and the valuation history. But today, we don't have that much time, so I'm only going to show you the accounts elements. But this is very important. And what we start with is with the balance sheet. And we go through a long history of the balance sheet. It's all standardized. We go through all the ratios. We go through the 10-year history of the P&L. Again, standardized. We standardize the cash flow. We go through our charts. We go through the latest accounts. And what we show is, I like to use a combination of parameters depending on the industry and company. So what I'm going to do is I'm going to walk through a stock and just show you how I would look at the company at the first pass. So this is before the detailed analysis work. Remember, I was working at, multi-billion-dollar hedge funds where we were taking positions that were tens of millions, hundreds of millions of dollars. So you do an awful lot of work before you invest an 8-figure sum in a stock. And so this is the first look. It's a couple of hours review. But the reason I wanted to show you this is what most private investors, this is all a private investor can do. The professional analysis is obviously going to be much deeper. But what I'm going to show you is enough to get a really good impression of the quality of the earnings and the likely outlook. So we go through a company 2021 10K. We ask what's new, what's interesting, what's relevant. And the process that I'm going to go through with you is I'm going to go through the balance sheet. I'm going to go through the assets. I'm going to go through the liabilities. I'm then going to go through changes in equity, the other comprehensive income statement. I'm then going to go through the cash flow in its three components: cash from operations, cash from investing, cash from financing. And then, having looked at the cash flow, I'm going to review the debt position. And only then am I going to get to the P&L. And this is, I think, a big mistake that almost every private investor makes, every trader makes, is they start with the P&L. And they start with the P&L and they get carried away with issues in the P&L and they forget to look at the balance sheet. I'm going to show you why this is so important. And once we've had a look at the P&L, we then go into that in a bit more detail, looking at the long-term trends in revenue, the long-term trends in gross margin, which we break down if we can, look at the long-term trends in cost, the long-term trends in EBIT margin. So that's what I'm going to go through. And then finally, we'll kick off, we'll look at the working capital, the returns in capital, and any segmental analysis. If I was doing this in the real world, I would then continue the process and I would go into much more detail on the costs. I'd go into much more detail on the revenues. I'd look at the products. I'd look at the management incentives. I'd drill down into the returns. I'd have a very close look at the competitors, and I'd go into real detail in the valuation. In the online courses that we're going to launch at the end of this month, we'll go through the valuation, go through part of the valuation. Obviously, going through the whole thing would take a huge amount of time. And the stock that I've chosen is Disney. Now, Disney is obviously, everybody knows Disney, so it's a good stock to look at. And what I think is very interesting about Disney is if you study Disney's history, amazingly enough, Disney almost went bust because Mickey Mouse was loss-making. And Disney was saved by Snow White and the Seven Dwarfs because it was a huge success. And that allowed them to carry on and invest in the business. And in the mid-1950s, he came up with this idea of an ecosystem around his content. Now, this is what Disney looks like today. Obviously, instead of publications, books, and comic books, we've got streaming. You know, instead of magazines, we've got streaming. But the media have slightly changed. But this concept is core to almost every media organization in the world. And that is why I think Disney's a fascinating company to look at, is because Walt Disney was decades ahead of his time. This is over 60 years old. Can you believe that? So, why Disney? Well, it's a company that I'm interested in, but why might I have come across Disney? Well, one reason would be it had very weak recent performance. Now, bear in mind, these slides were done about 10 days ago because we've had a huge process of going into the, checking all the data and so on. So the numbers are not up to date as of yesterday, but this is broadly how the stocks behaved until about 10 days ago. And you can see that one of the ways that you might have arrived at Disney would be using your XTB platform. You could screen on 1 year return and you see Disney minus 25%. So it's got a lot cheaper. And obviously you can see here the chart, and interesting, the chart is showing some indications of bottoming out. You can see quite clearly there on the chart down here. So one reason might have been the weak recent performance, or we might just have been interested in, looking at media and entertainment stocks. And, if you use the platform, you can find the media and entertainment sector. I've actually shown here interactive media and services and entertainment. So two subtly different sectors. So you get not just Disney and Spotify, but you also get things like Meta and so on. But what's quite interesting here is that Disney isn't the worst performer, right? You can see that Snap and Spotify have been considerably worse. Now, You can argue about why that is. I mean, my own view is they've come from a very inflated valuation. And, you know, I was talking about Spotify, probably 4 or 5 months ago when Universal Music floated. And I was pointing out that Universal Music was a more interesting play because it was trading at a fraction of the value of Spotify. And unless you believe that Spotify was going to manage to overcome all the incumbent labels, which of course is a possibility, that there was a potential opportunity. But and the other way you might come to a stock like Disney is just looking for very liquid companies. And again, you can see that if you look for the largest companies, Disney's right up there, along with Alibaba, Facebook, Google, and so on, much bigger than Netflix, interestingly. So the XTB platform, quite useful in doing this sort of screening, and it was quite interesting to use it for the first time, because I'm a Sentio user. Sentio is an analytical tool. It's not a trading tool per se. And so it's quite interesting that the system's that powerful. But let's just turn to Disney and look at its 2021 10K and ask those questions. What's new? What's interesting? What's relevant? And one thing I should just point out, one tip from my years of investing as a professional investor is a good book about the founder or about the CEO is really helpful, because it can reveal the strategy, it can reveal the thinking behind the results. I mean, oddly, even a bad book, although it's more painful to read, can really help your analysis. And in fact, the book, The Ride of a Lifetime, is an outstanding book, and really, really worth reading. And if you're interested in Disney, then you must read this book. But the first thing that I look at will surprise you, because the first thing I look at isn't any of the numbers. The first thing I look at is the audit report. Now, it's very unusual. I mean, I can't remember the last time I looked at an audit report that was actually had been qualified. In fact, I can remember that. That was the Thomas Cook interim result just before it went bust. It was qualified on a going concern basis. But very, very rare. And when the audit report is qualified, the shares have already collapsed. But people don't look at the issues identified by the auditor. And this is, extraordinary to me. I had a cup of coffee with one of the senior analysts at one of the top funds in London. There's a very concentrated fund that has, a limited number of positions. The analysts are meant to do very detailed work. And he said to me, I can't be bothered reading the audit report now. It's so long. And I said, well, what are you talking about? The reason it's so long is the auditor is shining a spotlight on the issues he's worried about. And that is what you, as a shareholder, as an investor, as a trader, should be worried about. So if you look at the Disney audit report, it's concerned about the amortization and production costs. Exactly the same issue at Netflix. And the reason for this is that Disney used to write off its content costs, but it now capitalizes them and amortizes them. Netflix has always capitalized and amortized them. So what that means is when you produce a movie or a series, it costs you $10 million to produce. Instead of charging the $10 million that it's cost you to the profit and loss account when you publish, what they do is they say, well, we think this will last for 3 years or 4 years or 5 years. So if it's $10 million and they think it will last for 5 years, they'll write it off. They won't write it off at $2 million a year. They'll front end the amortization. But it's extremely difficult for them to figure out how many views is that likely to get, what's going to be the total revenue, how much are we getting now, and how much should we depreciate now. So this is why this is really sensitive. And so when you open the accounts, you should look at the audit report, because this is the area where if the company wants to fiddle, and I'm not saying that Disney's fiddling, I'm not saying that at all, but if they wanted to, this would be the area where the CFO has the maximum flexibility and opportunity to shape his own profits. So the first thing I look at after the audit report, the first set of numbers I look at is the balance sheet. And I start with the asset side of the balance sheet. And I always do this the same way. And what I'm interested in is, first of all, what are the total assets of the business? So we know that Disney's a big company. We just saw that it had a capitalization of $230 billion. So no surprise that it's got total assets of $200 billion. But actually, those assets are very significant, because if you thought about Disney, you might think, well, it's going to be quite an asset-light business. It's not. And then what I just do is I flick through and I say, where are the big numbers? Because what I'm worried about, especially in the asset side of the balance sheet, are the big numbers. On the liability side of the balance sheet, what I'm worried about are the big numbers and the numbers that look smaller than they should be. But the point I should just make here is that the balance sheet, I always start with the balance sheet. But in the case of a stock like Disney, it's particularly important because we've just been through a COVID period. And every company on the planet has had some impact from the pandemic. I don't care what it does, it would be impossible not to be affected by the pandemic. Disney's been badly affected, both in 2020 and in 2021, because the theme parks have been closed for large chunks of the year. The cinemas have been closed for large chunks of that period. So they've not been able to produce and release films. It's further complicated in the case of Disney because in 2019, Disney made a very large acquisition of 21st Century Fox from Murdoch. So what you've got is a period of the last 3 years where 2019 is distorted by this big acquisition, which was only in for part of the year. 2020 has got the full year effect of the 2019 acquisition, but it's also got COVID. And 2021 has got a COVID effect, but not as great as in 2020. So those 3 years are all have their own issues in terms of understanding the profitability of the business and being able to use that as a projection, a base to project forward. So this is, in the case of Disney, the balance sheet is even more important than normal. So what am I looking at here? I'm looking at 200 billion of assets. You can see that it's got 16 billion of cash. It's got 13 billion of accounts receivable, larger than I would have thought. It's got 1 billion of inventories. But look here, it's got content assets. So it's got 2 billion of short term and 30 billion of long term. So 32 billion of content assets, up from 27 billion. So we know that we've got to worry about content. We already know that because we've seen that in the audit report. And then we go down to the fixed assets. So it's a 4 billion of investments. That's not going to move the needle. And a 200 billion stock, 65 billion of assets, 37 billion of depreciation, 27 billion net. So I'm looking at this and thinking, okay, so the assets are more than 50% depreciated. Do we have a problem in that this company's got old assets that need to be replaced? Now, I'm not answering any of these issues at this stage. I'm just looking through. Remember, this is just my first pass. I'm just looking through to say, okay, what do I need to worry about? What do I need to think about? You've got a bit of construction projects in progress, a bit of land, $1 billion. Then you've got 17 billion of intangibles and 78 billion of goodwill. This goodwill actually relates largely to the 21st Century Fox acquisition, and the 17 billion of intangible assets are goodwill by another name. So 95, a short 100 billion, or almost half the assets relate to acquisitions. then when you start to drill into this, and I would just have a quick look as I was going through the assets. I would drill into this more later, but this is the note on the content. And I'd look at this because I'm already curious, because the auditor has made that point. And you can see here that it's got 26 billion of content assets plus 6 billion of licensed content. They've licensed in from elsewhere. There's 32 billion. The amortization relates predominantly to this produced content. But 8 billion on 32. The numbers for Netflix, just to put it into context, Netflix's amortization is 12 billion, but its assets are 92 cumulatively. So it's bought $92 billion worth of content in the last 10 or so years. So it's my contention that Netflix's content amortization is far too low. And Disney is actually looks relatively good relative. Just drilling down further, they've got the international theme parks, and the company's got 48% ownership interest in Hong Kong and 33% interest in Shanghai. And this just gives you a scaler for what those assets are. So when you're looking at the theme parks, you just got to be aware that they don't have full ownership of these other businesses. And you'll see, I'll show you in a minute, that some large minority interest relating to that. So that's the asset side of the balance sheet. And now turn to the liability side of the balance sheet. And you can see here that, again, you've got 200 billion of liabilities. Two sides have to match. Half of that is equity. Here's the non-controlling interest, which relates to the theme parks. And then you've got some other key figures. You've got 21 billion of accounts payable, and we'll need to look into that. We've got 49 billion of borrowings, and we've got 9 billion of redeemable non-controlling interest. So there's some sort of convertible pref with a put, or I don't know what this is at this stage. I know that I'll need to look into it. So that was the liability side of the balance sheet. One other thing I should have just said is the other thing you need to note is they've got 19 million shares of treasury stock. Useful to note that. I then turn to the consolidated statements of shareholders' equity. Now, this is a statement that you see in US GAAP 10Ks. So the US GAAP reporting. This is not something you'll see for a European, UK, Asian company, because they're not required to disclose it. But this is really pretty useful because it shows you how the equity has moved over the years. And you can see some really interesting commentary here. Here's a 34 billion increase down to the acquisition. So that's equity issued for the acquisition. Here's 67 billion retirement of treasury stock. Again, this has been used to fund the acquisition. And then you see this odd thing, revenues from contracts with customers. It's only 116 million, so I don't really need to worry about it too much. But the nature of this, the commentary is such that it's something that I will want to follow up because I don't know what it is. So looking at this statement can be quite helpful because it flags up issues like that. And this is going further down this statement, limited as to how much room you can get in the slide. I thought of doing this by going through an actual 10K, but the numbers are then so small, it's really, really difficult to read. And you can see that you've got equity compensation activity. So that's stock options. That's not a huge number. So I know that I don't need to worry about that too much. You've got effects of accounting changes. And if this was a big number, I'd start to get worried about it. But this is a new lease accounting standard. It's not that big a number. And the new lease accounting standard, both in the UK and IFRS and in US, the standards are really, really badly written. So I don't worry too much about any adjustments there unless they're really large. And then this statement of comprehensive income is something that I bet most of you watching this never look at. And it's something you should always look at, because some profits go through the P&L and some profits don't. And there's a very complicated set of accounting rules that explain all this, but things like a loss on the translation of overseas assets, a movement in the pension, these go through the comprehensive income statement. If you've got hedges, they go through here. If you've got, depending on the definition of the hedge. But if you've got a massive loss on hedging, often it will only go through the comprehensive income statement if it's not realized. And you need to know about that. So you need to look at this. And you can see here, in the case of Disney, the numbers aren't that significant. The last year it was a gain. The previous year it was a loss. I tend to look at these cumulatively, because if things are going one way and then the other way, then the chances are there's not something that's going to affect the valuation. If they're moving around every year, it's less likely to be a problem than if they're negative every year. If they're negative every year, I start to worry about it and start to dig further. And then I turn to the cash flow. And the first thing I do in the cash flow is I look at the cash from operations. The cash flow is in three parts: cash from operations, cash from investing, cash from financing. And the first part is cash from operations. This is the most important part. And what you've got to look at is you want to see that cash from operations, this number down at the bottom, is greater than the earnings. Now, you can see that that is the case. The earnings are $2.5 billion in 2021, and their cash from operations is $5.6 billion. But if you look back to 2019, they reported $11 billion of earnings and only $6 billion of cash. The reason was there was a big tax bill. So it's very easy to explain that. But it's very important to look at this check, because for the vast majority of companies, the cash from operations should be above the earnings. And if it's not, it's usually a problem of some description. I'll then look at the cash from investing, and this is just showing me the capital expenditure. So I can see that Disney's been spending about $4 billion a year on investments in the parks and resorts, aside from its content spend, right? And that is that obviously is very significant. And then here you see things like this: 38 billion in and 39 billion out. And what all this is the refinancing of its borrowings. So you don't need to worry too much when you see these big ins and outs. But what you want to look at is the dividends and how much stock is being issued. Those are the two key items here. And then you've got some other supplemental disclosures, which are quite helpful: the cash interest payment and the cash tax payment. Those are very useful to know. And then what I do is I'll look at the progression of debt over the years. And you can see that for Disney, the debt hasn't moved. The net, what I'm looking at here is the cash less the short and long-term debt. And you can see that the net debt position has been about $10 billion for most of the first decade of this century. And then it's gradually crept up in the 2013 to 2017 period, when Disney was very acquisitive, as I'm going to show you. And then with the acquisition of 21st Century Fox, the debt doubled. But interestingly, the debt has actually been declining, even though we've had COVID in the past couple of years. And now I'll turn to the P&L, and I'll go through the P&L in more detail later, but this is my first look at it. And obviously, as I said before, the P&L is not that meaningful, because here you've got 61 billion of revenue, a bit less than 2020 because of COVID, because the full year impact of the 21st Century Fox acquisition was less than the impact of COVID. And then you've got a bit of a tick up in 2021, but that number is going to be a lot higher in 22. And here you can see the breakdown. Sorry, I should just go here. You can see the breakdown of that revenue and that operating income. And you can see that I'm looking at 2019 because 2020 and 2021 have been badly affected in the park segment, right? The media and entertainment division's obviously been affected, but it's really been affected in the park segment. You can see that what you've got here, 18% margin in media and entertainment, 27% margin in parks. If you've ever been to Disney, you'll know why, because it is so expensive. But that media and entertainment margin doesn't look that great to me. And you can see here that we can look at the cost of sales, we can look at the SG&A, we can look at the D&A, and we look at restructuring and impairment charges. And I'll go into all of this in more detail in a minute. Just carrying on looking at the segments, Disney also reports geographical segments. Quite interestingly, it's got the Asia Pacific parks are 6.6 billion, but it reports all the sales of the content under Americas. So I don't think there's a completely realistic representation, because I'm sure that it isn't as US centric as this. And this is the sort of thing that I identify and then have to work out in more detail later. But let me just turn to the next part of the process, which is just looking at some ratios and looking at the longer term trends in the P&L items. And I always start with the revenues, and I take as long a period as I can, and I try and look at the long-term trend in revenues and the year-on-year growth. And you can see that Disney's been a fantastic grower, but a large part of this has been acquisitions, because this company has done acquisitions throughout its life. But you know, in 20 years ago, it was doing fewer things, and they were smaller. The company's a much smaller company. But, you know, it's made acquisitions of the Muppets. It famously acquired Pixar from Steve Jobs in 2006, and that brought Toy Story and them, those titles within the Disney universe. And then it did the acquisition of Marvel in 2009, a big acquisition again, another $4 billion after $7 billion in Pixar. And then it paid $4 billion for Lucasfilms, the Star Wars franchise, in 2012. And the most recent acquisition was that 21st Century Fox is $71 billion. I mean, that is really a massive, massive, massive deal. But those are some of the titles that you can see coming in. And, you know, typically this is what I'll do. I just look at, you know, oh, it owns the PGA golf rights. It owns the Simpsons. You need to go back through these acquisitions to understand, you know, what's it bought, why, and how does that fit into the product portfolio. Obviously, that's beyond the scope of a short presentation like this, but just to put the revenue growth into context. And then I'll look at the gross margin trends. And obviously, what we're seeing in the most recent dip is COVID affected. So it's very hard to draw conclusions. You can see that there was a restatement here, and the margins, as restated, have been running about 45%, and they've gone down with the 21st Century Fox. So I'm expecting them not to stay at 45%. And you can see here, it breaks the gross margins down into products and services. And you can see that oddly, the products have a higher gross margin than the services. So again, this is something that is unusual and which I would like to investigate further. SG&A has been going up, but this is partly the reflection of the acquisition of 21st Century Fox and the fact that revenues haven't fully returned to normal. So I know that the SG&A to sales isn't going to stay at 20%, and it's going to trend back some way towards 15. And I'd need to go to a lot more work to understand, is it going to be 18, is it going to be 17, or is it going to be 16? And I would use a lot of sell-side research to do that. Obviously, if you're a private investor, that's much, much more difficult. And you just got to look at what the consensus estimates are and ask yourself, do they make sense? And here's the other recurring operating expenses of sales, again, affected by these distortions. But you can see that they've been running at about 5%. So you should expect that there will be 5% or more of other costs. And here's the margins. Obviously, again, COVID affected, but they were running around 25%. They've fallen since, and they'll probably be lower than 25%, I'm guessing, with 21st Century Fox. And the other thing I do is I try and look at what the margins been last year versus 5, 7, 10 years ago. I've used 2019 as the base because obviously 2020 is COVID affected, 2021 similarly. And what I try and do is I try and look at how much has the gross margin moved, how much has R&D moved, how much has SG&A moved, how much of, in Disney's case, other recurring costs moved, and overall what's been the effect on the margin. And you can see that the gross margins declined very significantly, offset by small saving in SG&A and some savings elsewhere, so that the overall margin hasn't been as badly affected. And then just to turn to working capital, I use the concept of the collection cycle, and I think this is a really, really important concept because it measures the company's overall investment in working capital. Remember, your free cash flow is after capital expenditure, after working capital investments. The EBITDA ignores CapEx, ignores working capital. So you need to look at both of these metrics. And remember, companies can neglect capital expenditure in the short term, but you have to fund working capital. And this is Disney's collection cycle. And this is an incredibly important chart to look at. And in the case of Disney, I would actually, if I was doing this for myself, I would add in deferred revenue and make some other adjustments. But I want to just show you the concept rather than showing you the rinky-dink subtleties that you can add in, because this is a simple concept. How much how much credit do your suppliers allow you to take, and how much credit you give to your customers, and how much have you got in inventory? And you can see the black line is the net effect of this. I've scaled all this by sales, and you can see that in the case of Disney, it's had massive increase in its payable days, 2019, 2020, and 2021. So it's gone from having payable days of about 70 days to over 120 days here. And as a consequence of that, that collection cycle has slumped, and it's minus 60 days. So its working capital is negative to the tune of 1/6 of sales. That's a very, very helpful metric, because what that does is it both boosts your free cash flow and enhances your return on capital. The problem for Disney is this may not be sustainable, because those payable days are very long. And if they go back towards that 70, 80-day level, then this number, the collection cycle, will go back up towards that smaller 10 or 20 days negative. What that means is that in 2022, Disney could see a big cash outflow in working capital, which means that its debt will go up, or it won't go down by as much as it otherwise would have. So this is an area which investors, traders often ignore, and you shouldn't ignore it. It is worth spending 5 minutes looking at. And finally, ROIC, the metric that almost every investor worries about. And you can see, again, we've got a distortion from COVID and from the 21st Century Fox. You can see the company was seeing a substantial long-term trend up. This has collapsed. My guess is that this will, fall back. When we get to here, it won't be nearly as high as it's been in this period, because of the money that they've invested in 21st Century Fox, because it'll take some time to see a return from that, and because the streaming business will be loss-making. So the streaming business will depress the returns. But what I think is quite interesting is that the returns aren't that high. If you looked at this for a Facebook, the numbers would be double that. And Disney, in theory, has got these fantastic media assets. It should be making higher returns than it is. And it's much asset heavier than people realize. And that's why the returns don't look so good. So finally, I just want to conclude by a little bit of commentary on CFDs. When I was at the hedge funds, we used CFDs. And, CFD, very simple, just a contract that says the buyer must pay the seller. The difference between the current value of an asset is value at contract time. It's effectively the same as owning a share, but it has certain advantages. because it allows you to profit from the price change without the ownership. And the advantage is stamp duty and taxes. So hedge funds in general I'm not allowed to tell you what the reasons that the hedge funds I work for used CFDs, because I have a non-disclosure agreement that's about this long. But the hedge funds in general used to use CFDs for three important reasons. The first was that CFDs didn't used to be covered by ownership disclosures. So you could buy more than 29.9% of a company by buying 29.9% of the company in stock and then buying CFDs to increase your ownership without triggering the UK's takeover rules. So it's a UK specific thing. The UK authorities have closed that loophole now, but it was a loophole that existed in the past, and it would allow you to do quite a lot of, increase your ownership without anybody knowing. Now, if you own a stock through CFDs, you have to disclose it as well. But that used to be a loophole. The second most important reason is lack of stamp duty. If you're dealing in CFDs, you don't have to pay stamp, and that's a huge frictional cost. And the third reason is that you can get away with less capital, because if you can buy on margin, then you're introducing leverage. So those ownership disclosures have been tightened, the margin requirements have been tightened, and the main reason most private investors, especially in the UK, use spread betting or a CFD is to avoid capital gains tax, and that makes it very, very efficient. So that is the end of the formal parts of my presentation. I've allowed sort of 10 minutes at the end to answer questions. I will hand it back to Caroline. Thank you very much for listening.
Thank you so much, Stephen. That was so informative, and I hope everyone listening realizes how valuable a lesson they just got. You've pretty much just learned how to read a balance sheet from an award-winning forecaster. So if you want to rewatch this, which I'm sure you will want to, then remember that XTB is recording the whole thing, and clients are able to get access to a recording to make sure you get an XTB account. So
I got my XTB account.
Oh, you've got one. So you can get access to a recording.
Well, I'm looking forward to the rest of the show. Unfortunately, I've got other things on this morning. I'm gonna catch up later. I'm particularly looking forward to the WallStreetBets and hearing that story. Yeah,
that's going to be very interesting. So, do you mind if I ask you a few questions now?
I would love you to ask me a few questions.
So, what would be 5 stocks that you're keeping an eye on this year in 2022?
Well, I mean, oddly, I've got a list of 20 stocks because I'm launching the newsletter. I'm launching whenever the website gets finished, the new website gets finished. But I've got a portfolio of 20 stocks I'm going to be monitoring, and that's obviously the big tech stocks because they're very interesting. Tesla, because it's very interesting. I'm on record as saying that I think Tesla topped last year. There's a video on my YouTube channel which talks about that. It was one of these things that you probably don't want to do, but I thought I'd better do it. And I've got a number of other stocks I think are quite interesting. I'm looking at things like Ferrari because I think it's hugely controversial, my view, but I don't. And I say this as a Ferrari owner and lover, but I don't think that Ferrari is going to make it have as easy a transition to the electric age as people believe, because part of the thing about there's a joy when you take the cover off and you look at the car, but then for me, you get in the car and you start up, it's the noise of the engine. That's that's part of the experience. Now, I mean, it's a very simple concept, so I'm going to be looking at Ferrari, and there's a few others. I'll be talking about it in the first newsletter. But the main, most of these stocks I'm talking about are stocks where I feel that there's certain vulnerability. Right. I'm also, I'm interested in Unilever as a long. I think Unilever is going to have quite an interesting 2022 because I don't think the chief executive is going to last. and there's a few.
Right. Well, very interesting. I was making notes there. We've got a question from Wendy who's watching. She says, what is the most common mistakes when trading CFDs? Good question.
What's the most common mistake in trading CFDs?
Yeah.
Well, I'm probably not the best person to answer that. I mean, I mean, people are better at buying than selling.
Right.
I think that would be the general thing. So selling too early is a very common mistake, because you sell too early because you get sucked out because something happens and you're scared the share price goes the wrong way and you cut your losses too early. Cutting losses is always a good discipline, but the worst one is the stock's gone up, you've got a profit, and you get out before and you leave too much on the table. I think that leaving money on the table is a heinous crime if you're a professional investor, and it's not good if you're a private investor, because that you've done all the work. You just, you should either be patient or come out over a period. So don't, you think, oh, I'm going to sell now. Don't sell all of it. Sell a bit of it, and because the trends go on longer than you think.
That's really interesting, actually, because I know some people say, "Oh, you never go broke taking profits," but it's interesting to hear the other side of it.
You never make any money taking a profit, Well, yeah, I mean, it's true. I mean, yeah. If you've got a winning stock, it'll carry on for much longer than you initially believe. So you should be slow to take profits, I think, is the.
Yeah. Okay. Absolutely interesting. Well, what changes have you made to your strategy in the current climate? So with current volatility, have you made any changes?
I've been selling.
Right.
I think there's a number of issues, but recent events have been absolutely tragic. I've just donated the Russian the royalties from my Russian book sales to charity. Interestingly, Tim Ferriss said that his were $15,000, which I'm obviously the rights to my book in Russian were obviously extremely attractive, because I don't sell 1% of the books that Tim Ferriss does, but I can tell you it's a lot more than 1%. Of his royalties was my advance. My advance was $1,500. Wow. But I think that what we've seen is, and I've got no insight into how events will unfold, but for sure energy prices have gone up, and they're not going to go all the way back down. And I mean, I thought energy prices were going to go up anyway. I think what this has done is increased the likelihood of higher inflation. I mean, we rely on Russia and Ukraine for 30% of wheat. And, we can't do without wheat. Right? I mean, it's just, very difficult to substitute. We can't do without Russian oil and gas. We can't do without nickel. I mean, there's a huge range of commodities. It's highly unlikely that the prices for those commodities won't be higher going forward, because some people will refuse to buy Russian products. Yeah. I mean, I think, I feel sorry for people in Russia, because I believe that Putin is not supported by the vast majority of the populace. I mean, obviously it'll be supported by some, but, there's a lot of people in Russia that are good people that are going to suffer from all of this. But I think there's going to be a global movement that says we don't want to buy Russian products, which means that anything Russia produces will go up in price, because the other producers will be, will have a higher demand. And that means that inflation is going to be even more strongly embedded in the system. And that has very profound consequences for us as investors, because what that means is that the qualities that you look for in a company are quite different.
Yeah, we've got another question from someone who's watching. Ellie has asked, you mentioned Tesla. When will they launch the Tesla mobile?
The Tesla mobile. I don't even know what the Tesla Mobile is. I know nothing about Tesla other than the shares are too expensive. What is the Tesla Mobile? Put it
well, hopefully we can get someone else to answer that then. Okay, well, let's move on to another question.
I've never heard of it. I mean,
does that mean like mobile is in phone, or is that's what I'm thinking of? But maybe I'm going down the wrong.
Teslas are all mobile. They all move.
Yeah. I know.
They even move. One of my friends got out his Tesla in central London because a taxi was blocking the way, and he said, "Can you please move?" And his car started moving. When he was out, he was running back to it.
Yeah, my brother's got one, and he always does that, and it gives me a heart attack thinking about it. So we've got another question from Ruler, who's asked, "What's your view on Chinese stocks listed in USA and DD in particular?"
Well, the changes that were made very recently, this last week, I think must be a massive relief to owners of Chinese stocks in the States. I mean, I've been saying for some time, I didn't understand. Charlie Munger's bought Baba, the US quoted Alibaba, and I thought, well, that's just crazy because you'd be better off. He can buy the Chinese A share. I mean, he can get a license and buy the Chinese A share, and that's what I would have done in his position if I'd shared his belief about the valuation. But the US stocks were fundamentally at risk because of this US auditor ruling. Now, I was interviewed by Kyle Bass for Real Vision about 12, 18 months ago, and that interview is available on YouTube on the Real Vision channel. And what we were saying was that unless the Chinese authorities allow the US SEC to look at Chinese audits, then these companies will not be listed anymore. Last week, that ruling, the Chinese relaxed the restrictions. So that was a really important sticking point. So the opportunities for Chinese stocks listed in the US are better today than they were a week ago by an order of magnitude. And you saw that because you saw the Chinese tech stocks go up significantly in China on Tuesday or Wednesday when that was released. But and Didi, well, I think the outlook for Didi depends on, have they done their time? I mean, I don't have any insight into the Chinese authorities' view of Didi, but the Chinese authorities do not like Didi, and as long as they don't like Didi, Didi is not going to be an attractive company or an investment. When they decide that they've given Didi enough punishment, will be a great opportunity, but I've got no insight into that.
Oh, thank you so much for today, Stephen. You've been excellent. It was so good to hear from you, and we got a lot of really valuable information there. So thank you so much, and enjoy the rest of your weekend.
Oh, thanks for having me, Caroline. Don't forget to email me. I'll send you that book. Take care.
I absolutely will. Thank you so much. So up next, we have Walid Koudmani, who is the Chief Market Analyst Trader at XTB.com. And today he is going to be discussing what I call the golden question, and that is how to trade gold and oil in times of geopolitical tension. Welcome, Walid.
Thank you very much for having me. Thank you, Caroline, and thank you to obviously all our speakers today. Thank you to everybody who's here with us. As Caroline mentioned, I'm Chief Market Analyst for XTB. We do quite a few of these events to keep you up to date, but today's a special occasion, and I'm very happy to be here. So thank you for having me in this talk as well. A key topic we're going to be talking about today is trading oil and gold in times of volatility, and especially as we've seen, there has been a lot of volatility as of late. I'm going to be covering a few other commodities as well, just to give you a bit of an overview of the commodity market and what's happening, because commodity traders tend to look through the general market and see what's happening. A lot of them can also be related to news. So that's something I try to stress in my webinars, is the correlation and kind of lead to understanding of why things affect each other. So when you look at the news, understand a little bit why certain things affect the price. Some of them may be more obvious, like the price of oil, for example, while some of them may be a little bit more obscure. So I'm going to try to shine a light on those things. So thank you once again for having me. And I'm looking forward to a Q&A section towards the end. So if you have any questions from the audience or somebody who has any doubts, please feel free to ask. And I'll do my best to answer your question as best as I can. So Yeah, thank you again for having me. I'll be going through a presentation as the other speakers as well. So, and then after, if anything is unclear, if anything extra is on the table that I didn't say, please feel free to ask any questions about that. Okay, so let's start with what we're going to be talking about today. So we're going to take a look at the general overview of the commodity market. And as always, this is not investment advice, but it's just a general overview of the current situation in the markets. And let's start with the real impact that rising prices are having on the economy and on the life of everyday investors and everyday consumers. So for the economy, especially in Europe, as we are the closest, we have to take into account the general geopolitical situation, which, as many of you, if not all of you know, there has been the ongoing Russia-Ukraine conflict, Russians invading Ukraine. That has brought up a lot of volatility, a lot of uncertainty in the markets, justifiably so. And interestingly enough, both those countries are very high producers and exporters of natural resources, whether it be oil or gas or even wheat, as we're going to be covering later on in the webinar. So the closest continental geographically, obviously, is Europe. So for the economy, especially in Europe, the biggest threat is the further increase in raw materials. They have already risen dramatically, and sanctions may exacerbate further. This is the main reason why Europe is afraid of Russia cutting off SWIFT. So this was one of the main concerns. So obviously, we've seen Russia being cut off of a few Russian banks being cut off from SWIFT. SWIFT is the international payment processing, which allows the communication between banks. That would be really troublesome for Russia, because then they cannot sell their energy commodities and then receive dollars for them, effectively cutting them off from the international market. Higher prices mean lower margins for companies, a gradual fall in demand, and a difficult situation for central banks. So as we can see here, we've seen a share of the global export along with the price change year to date. And we've seen natural gas have the highest so far, coal, oil, palladium, and platinum, which are some of the less discussed ones actually, but quite important, because a lot of people assume that if we get off oil especially from Russia, then everything is going to be good. We can move to electric energy or electric vehicles or something like that. But electric vehicles and batteries have to be built using these materials, including platinum and palladium, which Russia happens to be the number 1 and 2 exporter of. So that dependence doesn't end just with oil. So keep that in mind as you evaluate the situation. Obviously, raw nickel, aluminum, semi-finished iron, wheat again, a major export from both Russia and Ukraine. And as we're going to be covering later on, you'll see where that goes, most of it. So the real impact that this is going to have on consumers, if you are a consumer, which I'm sure most of us are, the problem is that oil doesn't just affect you if you drive a car, especially a gas car. It affects you if you buy anything, because oil prices are tied into transportation costs, are tied into production costs, energy costs, and all of that then is going to be reflected on the end consumer, who has to pay more for their goods, because as a producer, I'm not going to take on the full cost of the extra oil, the extra gas, the extra energy, and then just at a loss sell you the same product at the same price. I'm going to have to offload that cost onto the consumer. So that's what we're going to be seeing, and that's what we have already seen in both in the UK and in the world, particularly in Europe. Europe will also suffer in logistics. Even before the conflict was, the world was facing huge disruptions in supplies. So we're coming off of, not forget, the COVID pandemic, which caused massive uncertainty, massive volatility once again, and massive shortages, supply chain issues, which we're starting to alleviate slightly as time went on. Now, the hardest, these are set to escalate, with Europe being the hardest hit. A stagflationary scenario is becoming more realistic. That is, with high inflation causing a slow in the economic growth. In fact, even perhaps a slowdown to the point where it starts to decrease. So while that is not the reality at the moment, even though some economists seem to believe it is, and they might have a point, that is the prediction moving forward if this happens, because we have increasing rates of inflation. So what is inflation? In essence, it is just a devaluing of a currency because of several factors. But at the same time, we've seen incredibly unprecedented monetary and fiscal policy from central banks, which has led, along with all the practical factors, into rising of prices to an extreme level. So we've seen the highest level of inflation in 40 years in the US and Europe, and this is all transferring onto the consumer. So if the consumer is losing all this value in their money and they can't afford to buy any more things. For example, $1,000 today would not buy you the same thing that it would buy you a year ago or 2 years ago. Then you get to a point where prices are so high, consumers cannot afford to continue buying. The suppliers are starting to make a loss. And then that starts a cycle of nobody's actually making money and nobody can actually spend money. So that's the situation we might be headed for if these prices continue to increase. But what do we know about the oil market? So the oil market in particular is one of the most interesting ones for me because I can tie it a little bit more closely to supply and demand. So as much as I like stocks, FX, and other markets as well, for me, in my mind, personally, I understand the oil market because I can look at the news. And one of the main things, we come from a generation, or let's say we come from a time where there was a lot of conflict in the Middle East. And, it's quite obvious to assume that if these are oil producing companies and there's a conflict there, that would allow potential shortages for the supply chain coming from there. So if there is, by the basic laws of supply and demand in economics, the lower the supply with the same demand, price is pushed higher. So now that is not always the case, but that is the basic law of that supply and demand. So that is how I can kind of associate the oil market in a more practical way, where I look at the news, I see, okay, these are oil producing companies or countries that are having geopolitical issues, supply disruptions or whatever. The supply or the demand seems to be increasing. What's gonna lead? What is that going to lead to? So let's take a look at the oil market in a little bit more depth and see what is happening and what are the risk factors for the oil market as a whole. So the key topic on the markets is destruction of demand. That implies that prices become so high that nobody can buy oil anymore, or very few people can. Goldman Sachs believes that oil market rally can only end through demand destruction. So those are the two scenarios here, where either the conflict is resolved, and whether it be in the Middle East or in Russia or in somewhere else that produces oil, or prices become so high that demand is just destroyed because nobody can afford to buy oil anymore. And oil producing countries and companies have to then absolutely take the hit at that point. So it is assumed that even without sanctions, about 3 million barrels per day of Russian oil and oil products are frozen, half of maritime exports. So we've seen a lot of news regarding that, where oil exports from Russia have been halted. A lot of tankers are not approaching Russian coasts. A lot of international waters are closed to Russian ships. So effectively speaking, a lot of Russian exports of oil through the sea have been blocked. However, through land, actually, there's quite a few European countries, including Germany, who have not stopped their Russian imports. This export freeze, we've also seen, actually, touching on that, a lot of private companies like Exxon, Shell, and so on pull out their investments from Russian oil and from the mainland. This export freeze could occur at around $165 per barrel, which we did not really get to, based on Goldman Sachs demand destruction level study. So we can see that over here. OPEC will not be able to save the situation, though. So OPEC's spare capacity is less than 5 million barrels per day. The UAE has scored the biggest expansion, so they want to raise production. However, OPEC, led by Saudi Arabia, does not see the problem in the market. Again, I actually covered this in a webinar a long time ago on commodities, which you can find on the YouTube channel. But what I mentioned in that webinar was how different countries have different prices of production for oil. So, for example, Saudi Arabia, I think at the time, this is about mid-2020 or so, a barrel of oil cost about $12 to produce. In Russia, it was around $20, and in the US, it was around $45 to $50 to produce each barrel of oil. So what you have to have is a break-even price, where if you produce a barrel of oil you're selling at the time, at least for $30, if you remember, we had that huge crash in the price of oil with the demand really destruction because of COVID. It wasn't profitable anymore to produce oil in the US. Now, anything past $50, you're already starting to make a profit. In Saudi Arabia, anything past, let's say $15, you're already starting to make a profit. So I don't think that these countries really see an issue with selling their barrels at $140 when it costs them $12 to produce. Most OPEC countries will oppose raising production limits, as they're not able to produce as much as they're allowed, because OPEC, as part of their agreement as a group, they have production limits set for each country. Now, historically, a lot of them break those production limits, so it's not necessarily set in stone, but at the same time, they're a general guideline. Saudi Arabia, UAE, and Iraq have real chance of raising production, but need the agreement of the whole cartel, and most of the time at least. That's the thing, is you have to go to the countries that can produce the most and then get that supply from there. Europe should manage with oil, though, so it shouldn't be a catastrophe for Europe, because, as I said, if you go and look at how much oil is exported from Russia, it's not, I mean, in the grand scheme of things, it's about 3 or 4% of global production, which is a lot, but it's not the most. The Netherlands, Germany, and Poland buy the most Russian oil and fuel in Europe. As you can see here are some of the pipelines. S&P Platts estimated about 2.2 million barrels per day of oil is flowing countries supporting Ukraine. These are levels that are theoretically replaceable by US and OPEC countries. Now, we're going to go into how these things can happen, how the replacement can happen. It's not as practical as having a direct border with a country that then can feed you oil through the pipeline. But there are practical ways that this can be done. Now, probably not overnight, so nobody can expect necessarily, besides a resolution of the conflict and de-escalation, something to happen overnight where oil prices drop. But at the same time, this is not an unsolvable situation. JP Morgan predicted levels of $120 in the event of a Russian invasion. So we saw that actually be exceeded significantly as well, and then pulled back. Now, we've also almost canceled that whole move on the chart. So if you look at the chart of oil prices, it's almost like a reverse V. It's an A shape, basically. And just as quickly as they go up, they can also come down based on what's happening. So the volatility in the market really is incentivizing a lot of uncertainty as well, because as volatility increases, the certainty of price prediction decreases. And oil market in particular is very much based on stability of prices, because suppliers have to know how much they're selling, buyers have to know how much they're buying for. Everybody in between is actually using those products, so they have to account for those in their costs. Companies have to account for those. And at the same time, unlikely or unplanned events can have a major impact, because in the market, sometimes it's not necessarily bad news that has the more effect than the good news would. What has the most effect is unpredicted news. So the more unpredicted something is, the more it can have an effect on the market. So I don't think anybody really expected the full-scale invasion that we saw. I think a lot of people were, looking at the news, seeing that there were troops amassed on the borders. There was already some turmoil in the eastern part of Ukraine. People thought of that. Nobody really thought that this would continue. But the more unexpected something is, the more shock it causes in the markets. Now, Russia seems to have the plan B of selling to China. So that's a realistic thing, because they already buy a lot of Russian oil. And if nobody in the Western world is buying Russian oil, then Russia has to sell their oil at a cheaper price to whoever's willing to buy. At this moment, it seems to be China and India. And where can Europe look for substitutes is the real thing that I was going to talk about. So we have a few prospects, as you can see here on the screen on the left-hand side. Nuclear deal with Iran. Iran has around 100 million barrels of oil in offshore storage. Reaching agreement could bring around 0.5 to 1.5% increase. So what could happen is Iran could provide about 1.5 million to 2 million barrels per day of oil supply into the markets. The Iran nuclear deal, as some of you may have heard of in the past, is something that Obama signed, where Iran would be accounted for their nuclear production and nuclear scientific research, and then in exchange they would be able to export their oil. However, under Trump, that got revoked, and ever since they have had basically no access to the international market. If that were to be reached again, we would have another access of oil from Iranian market. Furthermore, U.S. is in advanced talks with Venezuela over lifting oil sanctions, another country where they have a massive production potential of oil. But once again, they are sanctioned by the United States. If these sanctions are lifted, we could be seeing another 1 million to 1.5 million, maybe 2 million barrels per day of U.S. supply. So what would happen is a kind of a roundabout way of Venezuela sells to the U.S. and then the U.S. sells their oil. So the U.S. sells U.S. oil to Europe. So and obviously the U.S. would be importing Venezuelan oil. So that's another potential. So we have already seen about 2 to 3. I mean, if you just count these, let's say 3 million barrels, we've already covered almost most of Russian supply. Number of active oil rigs in the United States sits around 500. In pre-COVID times, it was about 800. Each active rig amounts to an average of 1,000 barrels per day of increased production. U.S. shale producers could boost production by around 300,000 barrels per day. EIA, so the International Energy Agency, expects it to be 200,000 barrels per day on average. OPEC Plus could, so Plus is including Russia, but let's take out Russia for this, is around 700,000 barrels lower than agreed on. However, this is a result of restoring production. So we've had a lot of issues restoring production after COVID. Again, we are coming from one crisis into the other, really not catching a break on that end. But there are a lot of basically ways that we can restore production of oil even without the Russians. OPEC has around 5 million barrels per day of spare production capacity, with half of that being in Saudi Arabia, UAE, so the United Arab Emirates, and Iraq. So these are some of the ways in which Europe can access more oil. So as I mentioned, this is not an unsolvable crisis when it comes to the oil market, and then in the long term, really, it isn't an unsolvable crisis. We're moving into renewable energies, but this isn't something that happens overnight. These talks with Iran, Venezuela have been going on for weeks, if not months. Really, with Iran longer. Venezuela was kind of the card they were playing, they were holding in their pocket. But it is interesting to see how these things can cause massive geopolitical changes just because of the necessity that they have. Now let's talk about China. China is able to purchase all of Russian oil that Europe does not want. So China is, the second biggest economy in the world. They have a massive need for oil. China is currently importing around 10 million barrels per day of oil per day. However, they import in 12.7 at peak. Increased imports may allow to refill reserves that have dropped by around 100 million barrels since peak in November 2020. So if you remember, at the beginning of the pandemic, obviously, China was one of the first countries, if not the first country, to recover from the pandemic. And what happened was, as soon as everybody was selling their oil for cheap because they were closing down, China was the one buying it, refilling their storages. So ever since that dropped, though, now they have had the chance to refill their storages with this potentially cheaper Russian oil. Russia exports most of its oil via LR and MR tankers. Russian oil exports require around 10% of global fleet of such ships. China, twice as many tankers as required. However, high freight prices could pose a challenge. So again, this is all tying into each other. These freights use oil to travel. If oil is more expensive, then oil is more expensive to transport. So then oil is more expensive once again. So it's a cycle of rising prices that goes and impacts the final consumer in the end. So we have Europe with these potential ways that they can actually manage to overcome the Russian supply shock. And then on the other hand, we have China, who can buy all that Russian oil that Europeans are not buying. Liquid natural gas is not a solution in the short term, as some may have speculated. Europe has around 30 LNG regasification sites, so liquid natural gas is then turned into gas once again. 2/3 of the world's LNG is sold under long-term contracts. So the main customers are South Korea, Japan, and China. So you have to have a multi-year contract to then establish supply chains. They have expressed to redirect their supplies to Europe in case of suspension of gas exports by Russia to Europe. So that was a real potential risk that was occurring. The Economist points out that 10 to 15% of Russia's gas supply can be covered by LNG quickly. In December, half of US LNG was going to Europe. And if the other half was added, this would recover 20% of Russian supplies to Europe. The world's biggest LNG exporters are Australia, Qatar, and the US. Russia sends around 23.3 billion cubic feet of gas to Europe daily. The entire global LNG market in 2022 is valued at 53 billion cubic feet. Global gas consumption is 400 billion, showing that LNG is still a small fraction of the total market. So as you can see, obviously, huge reliance of Europe on liquid natural gas from Russia and natural gas as a whole. We've not seen too much willingness of European countries, particularly Germany, to renounce that supply. But in the eventuality, we have several other sources where it could be redirected. And we've seen the willingness of countries like South Korea and Japan to be willing to redirect into Europe. Nat gas in the US, the whole gas market is around 90 billion cubic feet. The ability to export more and therefore influence the price is limited by the ability to liquefy gas. Prices in Europe are almost 10 times higher than in the US. A year ago, prices were only 2 to 3 times higher. So you can see that disparity where the US at the end of the day is an energy independent country. So they can actually a net exporter. But Europe is very reliant because of this, obviously, the geographical kind of nature of the continent. If anything is unclear, by the way, feel free to ask any questions. I'll try to get to them towards the end of this talk. Let's take a look at some more oil fundamentals. The price of oil has returned to its level it was before the outbreak of the Russian war in Ukraine. As I mentioned earlier, mid-year call options at $150 per barrel remain very high. Well, there were some call options at around $200 per barrel, which have declined significantly. So a lot less people, or a lot fewer people, are expecting now an increase to $200 per barrel. However, that was floating as a real possibility as we were approaching the all-time high, basically, of the price. Ukraine indicates that an agreement with Russia should be reached by May at the latest. So we've had some very positive signs from that end of the spectrum of the negotiations, where oil and gas may be restored. I don't know how much these things could be restored overnight. You know, let's say they reach an agreement tomorrow and there's a peace treaty. Doesn't mean that all these sanctions are done after tomorrow. Doesn't mean that they stay for another year. Doesn't mean that they never go away. When do these companies go back into Russia? When does the Russian oil? I mean, a lot of countries, including the UK, have expressed a strong willingness to detach from the oil dependence of Russia. So who knows if this even, is going to play into the major supply crisis. But at the same time, it's a good sign, obviously, if for nothing else, for a humanitarian reason. We do not want people to suffer wherever they are. So hopefully an agreement is reached. But Ukraine indicates that the talks are moving forward. Russia, we've seen some positive language from there. They've moderated. They've kind of changed their language slightly. So we're hoping for the best in that instance. However, on the other hand, we've also seen a significant increase in the number of COVID-19 cases in China, a couple of lockdowns as well in some of the major cities, including Shenzhen, which is one of the tech hubs basically in China. Beijing has not recorded an increase of more than 1,000 cases in the last 2 years. If tighter restrictions are introduced, oil demand could still respond. Still, the situation is not very optimistic, looking at the prospect of a return to lower prices. So I'm sure many of you have encountered this in your daily life, where the price of oil or gas or gasoline in that particular matter has increased significantly if you drive a car. If you have energy bills, I mean, as somebody who lives in the UK, obviously, we've been, this has been mentioned over and over again, where energy prices are going to increase, energy bills are going to increase. Sure, the government is going to try and step in, but, it's a tiny dent in the problem that we are facing. Crude, as you can see here from the Bloomberg chart on the left, crude call options at around $200 have depreciated significantly, which shows that the market does not believe the price can rise to this level. So that's a good sign, at least. We are still very, very high compared to where we were, let's say, a year ago, especially considering a lot of banks were expecting oil prices to reach around $100 by the end of 2021. And now here we are. We're back at $100 roughly and in the first quarter of 2022. But we were heading towards 150 just a week ago. So that's the nature of the volatility in the market and how you have to account for it. Let's say we're not even talking about from a technical point of view on the charts, but just from a news point of view. Here we have a bit of a graph or a chart showing the Russian energy exports and the distribution. So we see the distribution changing slightly from one month to the other. So this is January, February, and March. India may see an increase in demand this year of over 200,000 barrels per day. The decline in exports from Russia is already visible based on Reuters calculations. As you can see, the Iran nuclear deal is not certain. It seems to be fluctuating back and forth. The United States hesitates because it does not want to grant more sanctions waivers than under the 2015 agreement, the one that I mentioned under Obama. Russia, in turn, blocks the deal because it wants to access the market with no sanctions. And we've seen Brent trading around $100, while WTI around 96. Now, this is fluctuating on a daily basis, but that is the range we're in at the moment. So if you look at the chart, you'll see that we have that A shape where the price spiked up and then went back down. We're back in the range we were towards before the conflict. So it's still a range in the sense if you trace a support and resistance, you will see that basically we're moving in a sideways range. But breaking through those can lead to a spike potentially. And you can see here, Russian energy exports declined noticeably after the conflict. They were actually increasing towards the end of February and then dropped significantly after the conflict. But obviously, this is not the only conflict that has ever happened in the history of humanity, especially with the dependence on oil. And we can compare this. It's not an exact science. Comparing, obviously, the past does not equal the future. As you can see here, refers to past performance and is not a reliable indicator of future performance. But what is interesting is that it is important for us to analyze history and to see how things have affected the prices of certain assets in the past. So one of the more comparable examples really is the Iraq-Kuwait war and the subsequent invasion of Iraq. Now, the 1990s one, so not the 2003 one, but the 1990s one, that led to a significant supply shock. So around 4.5 million barrels per day was frozen in the aftermath of the Iraqi invasion of Kuwait in the 90s, which accounted for around 7 to 8% of global demand back then. In theory, the current situation is very similar. While the amount of oil in danger is smaller, the biggest risk is that the majority of this oil was exported to Europe. Oil prices jumped 140% after the Iraqi invasion was launched, but have pulled back to pre-invasion levels in less than 1 year. So what we saw actually here is basically pulling back to pre-invasion level in less than 2 weeks. It might speak to the nature of our world at the moment, how fast-paced things are moving, and how much less volatile at the time they were, because prices just... What happens, as I mentioned earlier, the oil market is based on the stability of prices because it is so influential down the line and down the supply chain and all of that. Now, this much instability and price volatility is not beneficial to producers or to suppliers. It is not even beneficial to consumers, so it really isn't benefiting anybody. But lower prices could benefit most people in that instance. So the fact that in the early 90s, so about 30 years ago at this point, the prices took about a year to go back to their previous price. Now we saw them go back in about but they also increased a lot more because obviously Iraq was much more, let's say, noticeable supplier of oil. We can see that it does mirror that slightly in the beginning, but then immediately it drops off compared to what we saw in the past. So yes, let's take a look at history to see and analyze how things might compare, but it is impossible to make a prediction based on what happened in the past as well. So we can see the current situation is similar to the oil shock of the 90s, and based on this Bloomberg chart as well in partnership with XTB. So that was a general overview of the oil market with what all the fundamental factors are, how you can keep an eye on them, how you can keep an eye on what oil affects in the end, and what basically is happening in the oil market. So that is a general overview of what you can keep an eye out when you're trading oil, when you're trading these kind of commodities. Yes, they're going to affect you in your daily life. Of course, that's the main concern, I would say. But also, when you're trading them, take a look at the technical point of view. So take a look at the charts. Take a look at the supply and demand situation. Take a look at the support and resistances on the chart. Where does that fit into the supply and demand that we have at the moment? What are the prospects for the supply increase? So as I mentioned, the reason is oil is one of the markets I like the most is because the price really seems to be tied a lot to supply and demand. So maybe something like, Forex, it involves a lot of central banks, a lot of abstract concepts, bonds and yields and interest rates, which are very interesting, but maybe for most people are a little bit difficult to get into at the beginning. Oil prices are very much tied into how much demand there is, which you can tie into practical uses, both in your everyday life and in the everyday expenses that you have, and the supply, which is very easy, easier to tie into what you see on the news. And I would hope that if you're a trader, you're at least skimming the news, you're looking at what's happening in the world, because trading doesn't exist in a vacuum necessarily. So now there are some purely technical traders that only look at the charts. Sure, but how can you predict something like a conflict by looking at the charts? It's almost impossible. So, but if you were looking at the news and you saw these troops amassing on the border, you think to yourself, okay, Russia is a massive exporter of oil, so is Ukraine, or at least they go through Ukraine. Ukraine and Russia have a lot of natural resources. If there's a conflict, how could that affect? Let me take a look at what happened in the past when an oil producing country dealt with conflict. And here we are. So that allows you to then form an opinion on how you can kind of move forward on that end. So now let's take a look at some precious metals, some other commodities. And obviously, if you have any other questions relating to any other commodities or any other markets, feel free to ask them. I'll try to get to them in the Q&A section towards the end. So let's see. Silver and gold. So silver and gold, we haven't talked about silver that much. Gold seems to be the main driver here. But at the same time, silver is an interesting market because there always has been some sort of a correlation. And there's a ratio called the silver and gold ratio. And let's take a look at some fundamentals about silver. So you can see here, this is a Bloomberg chart. In line with the seasonality, which is a prediction based on season and time of the year of demand and supply, and price action. In line with silver price is falling, so that is not unexpected on that end. The bottom should be marked next week. So that is based on seasonality. Now, that might happen, that might not happen. That is just a prediction based on what happened in the past, which is not reliable per se, but is not abstract. Positive positioning on silver is growing strongly. The number of long positions is increasing. So this is on the speculative market. The number of short positions is decreasing, which means that when positioning is growing, it means that if you're CFD traders, you know that there's a short position and there's a long position. Short position means that you think the price is going to fall. Long positions means that the price is going to increase, or you think that at least. And that's when you open the contract. So sentiment is quite relevant because it is an aggregate of all the traders that would be trading this on some sort of a stock exchange or a stock market or an exchange in general. If we have more people thinking that the price is going to fall, likely what happens is the price is driven to fall because of a cycle. Basically, it's a psychological thing. On the opposite end, if most people think the price is going to go up, that's what generally tends to happen. However, obviously, as I said, geopolitical events, unexpected news, these things can have a large impact on the price. At the same time, ETFs, which are exchange traded funds, have been selling silver since the beginning of the war in Ukraine. Interesting thing to note. So ETFs actually are some of the main things to keep an eye on when you're trading precious metals, whether it be silver, gold, platinum, palladium. There's also oil ETFs. They are exchange traded funds which gather funds from a large number of investors, or sometimes smaller number but with larger capital, and they amass physical quantities of gold or silver. So they just buy and store silver and gold as a hedge against inflation, as an actual investment, as whatever they may think the actual practical use may be. So when we talk about precious metals, when we talk about any sort of commodity, we have to take a look at the demand. Not only, the demand distribution really is important. So oil, as I mentioned, that the practical use of oil is transportation, energy, and so on and so forth. When it comes to gold and silver and precious metals, gold in particular is more of a safe haven, traditionally speaking, let's say. However, something like silver has a lot more practical uses than actual gold. So gold is used in basically, again, this is covered in some other webinars we've done. You can find them on the YouTube channel. But what we've talked about is how the demand distribution for gold, for example, is majority might be some sort of investment. You have some in jewelry, some in ETFs. So ETFs actually account for a large part of that demand. So if their demand changes, then that can impact the price. Because once again, we're talking about, yes, you look at the charts, yes, you look at this, but this is all based on real assets that are being traded on the market. So if there was no asset underlying, there would be no market to trade on. So let's keep an eye out for the underlying market, what is happening on that, and then kind of export that information into the chart information. So I'm not somebody who's exclusively fundamental, but I think that a combination of fundamental factors along with the technical analysis can help you assess the best situation to both enter the market and exit the market, and also what market to trade. So you can use fundamental analysis to help you understand when is a good time to get into a market and what market is a good time to trade. Because one of the worst things that traders can do is try to force a trade. So when you don't see an opportunity and you're trying to force it onto the market, and maybe you lose money, or maybe your risk reward ratio in that instance is not as good as it could be. So let's move forward. The gold to silver ratio does not suggest that we could be dealing with a recession crisis signal. In previous cases, we saw a strong increase in the price ratio. So there is a ratio. Let's say gold is $1,000. You generally speaking, silver maybe will be $10. So that's the ratio. Maybe it's not 10 to 1, but that's the kind of thing where gold prices move, silver prices move. If there's a disparity between those two, it does generally account for some sort of a change in sentiment. You can see here net positioning is growing, meaning that long positions are increasing. It is at its highest level since mid-2021. At the same time, however, ETFs have been selling silver since the beginning of the war in Ukraine. So here we have a disparity between, you can see this on the chart, between the derivative contracts, which are the long and short positions, and the actual supply and demand of the underlying asset, where yes, long positions are increasing. People think the price is going to go up, but the actual supplies are being sold by ETFs. So what does that mean for the markets? That's up to you to decide in the way. The silver to gold ratio, you can see the blue line here, the dashed line, is a 50-year average. we are approaching a higher level, but not quite as high as we were between 2015 and 2019 and at the beginning of 2020. It is worth remembering that after the first interest hike in the US, precious metals usually gained, at least in the perspective of 6 months. However, the risk of a 50 base point hike in May is rising, which may weigh on the bullish scenario. At the same time, the market sees a chance that the Fed will stop further tightening at the start and start lowering interest rates as early as the middle of next year, similar to what happened in mid-2018 when precious metals launched the long-term rally. And here you can see gold to silver price ratio does not indicate an increased risk of recession. So we have to tie this all not just into the conflict, but into the others. So we have three major geopolitical events that are happening in the world at the moment. They're quite long-term. One is COVID. One is the geopolitical situation between Russia and Ukraine. And then the third one is the whole central bank scenario that is happening that you may have heard of, with central banks readjusting their monetary and fiscal policy after the unprecedented fiscal aid and monetary aid to the markets. So just to make it brief, interest rates and inflation tend to be tied to each other as well in normal circumstances. The interest rate is being adjusted. First, we're seeing a prediction that by the beginning of this year, so let's say by the third quarter or the first quarter, sorry, we actually did see that this week with the Fed. We saw that with the central bank, the European Central Bank actually holding back. That we can kind of tie into the fact that a rise in interest rates would be a little bit disrupted right now because of the fact that the conflict is mainly affecting Europe. So the US is quite outside the area. Central bankers in the US have been quite aggressive as well with their language, saying that they expect 6 more rate increases this year. So there's going to be a large change on that aspect as well. And gold tends to be as we've seen, a safe haven, traditionally speaking, in the sense that when volatility is increasing, when markets are unstable, gold becomes an attractive asset for that aspect, because there is not that much practical use for gold, let's say, besides some sort of microchip production or a few other niche kind of sectors that are using gold. At the same time, the market sees a chance that the Fed will stop, as I said. So it really is a fluid situation that could change almost from month to month. And they're going to have meetings. They're going to have 6 more meetings, and each one of them is expected to have an increase tied to it, but it remains to be seen. As far as the European Central Bank, it's becoming more likely that they will start to increase rates towards the end of this year, though. So gold is, let's talk about just a few fundamental factors for gold. I don't want to be going too long over this. Russia may use its gold reserves to stabilize the situation on the domestic market after around half of its reserves were frozen. So Russia is a significant producer of gold, around 10% of global production, but sanctions and SWIFT cutoff may make it difficult to sell or buy gold. So we talked about this at the beginning with the SWIFT sanctions. Russia announced that it is resuming purchases of gold on the domestic market. Such purchases were halted around 2 years. Russia is actually one of the main buyers of gold as well, because they like to hold that in their central banks. Russia holds around 2/3 of its gold reserves in Moscow and the remainder in other Russian cities. Gold accounts for around 1/5 of Russian reserves. Russian gold holdings are worth around $130 billion. Gold can be used to ensure the continuity of foreign trade amid sanctions, because it is a widely traded good. And Goldman Sachs midterm forecast points around $21.50 per ounce, $2,150 per ounce. We saw gold, once again, like oil, spike for different factors. So that's an interesting thing to keep an eye on, is the fact that, yes, they both spiked. One was for a supply crisis potential. The other one was because in times of uncertainty, the demand for these things like like gold and safe haven assets tends to spike. We saw the dollar also gain significantly. We saw cryptos, just very briefly, obviously Bitcoin and Ethereum spiked because a lot of the, let's say, Russians tried to evade those sanctions. And also we saw the donations going to Ukraine also spiking demand on that end. So we can see here the reserves, largest holders of Russian central bank foreign currency and gold reserves by location. Gold is the most in Russia, let's say. So that's the general overview. As I said, they can continue to use their reserves to ensure foreign trade, whether it be with the West or with other, let's say, China and India, because they have so much of it. Obviously, their foreign currency reserves in their central bank have been frozen, but their physical assets are still intact. So Now let's talk about just a few other commodities, just to briefly touch on them to, kind of fill you in on what's happening on those markets. Hopefully this has been useful so far. If you have any questions relating to anything I talked about or anything else that you might find interesting, feel free to ask them. I'll try to get to them in about 5 minutes. I don't want to get too long in this. So let's keep going with coffee market. Coffee. Inventories are increasing slowly. Net positioning is at the lowest in 5 months. This is the opposite of what we mentioned earlier. So short positions are at the highest. The speculators are leaving the market before the harvest season begins. There have been some alarming signs on the harvest season. Another commodity that's actually really interesting to follow because of the supply and demand. So you look at the news. What's the weather like in these producing companies or countries? Take a look. If the weather or the predictions are bad, then that can be a sign of something. If it's good, then it can be a sign of something else. Brazil's coffee exports fell in February on an annualized basis, but rebounded on a monthly basis. Traders point to diminishing problems in terms of coffee deliveries around the world. The harvest will begin next week in Brazil, which could boost global supply and trigger further declines in the short term. On the other hand, the first data will show whether worries about low yields are justified. So low yields, again, are the lower production. That would tie into low production. And you can see here, Brazil's exports are worse than a year ago, but have rebounded compared to January. Exports are still above the 5-year average, which is this dashed line. Wheat, I touched on at the beginning. Wheat is a huge export from both Ukraine and Russia. So look at, here you can see a hourly chart just a few days ago, basically. Ban on the export of wheat from Russia to the countries of the Eurasian Union, former USSR. However, so we saw this actually, some of the countermeasures from Russia as well, which were the ban of fertilizer exports and also wheat. However, this accounts for a maximum of 10% of all Russian exports. Exports to key buyers like Egypt and Turkey remain intact, so that's a key thing to keep an eye on. The price rebounds slightly after buyers managed to stop the decline around the support of around 1,050 cents. Deliveries from Russia through the Black Sea ports remain intact. According to APK Inform, the sowing of wheat, corn, and sunflowers in Ukraine may be about 40% lower compared to last year, as you would imagine, for the obvious reasons. However, further export bans from Russia cannot be ruled out, so that's the uncertainty and volatility that can be sparked on the market at any time. If you look at the chart here, this is an overlay. This is the X station chart. So if you have on the platform, you can see that we can overlay different charts. So this is the price of oil, the blue candles going down, and this is the price of wheat going up. The wheat price continues to increase due to uncertainty regarding harvest season. On the other hand, the relative costs, oil prices are falling. So relative costs because oil is used to transport, which creates a clear divergence. One should also remember about the export ban on fertilizers from Russia, which may result in higher production costs. Again, all tying into each other. Turmoil in the grain trade. So Russia uses 3 ports in the Black Sea, not the Azov Sea, where Russian commercial vessels were allegedly attacked. Russia does not use Ukrainian's water territory to export its products. Ukraine has lower wheat exports, but significant corn exports destined for China and the EU. Ukraine has stopped shipments from its ports. Egypt reports cancellation of purchases from both Ukraine and Russia. If Turkey decided to block Russians as well as Ukrainian ships, 30% of annual wheat exports and 20% of corn exports could be threatened. However, Turkey is a large buyer of agricultural products from the Black Sea region. Such a scenario is unlikely, and you can see here the distribution of imports and exports from these countries. So just finally, basically after this, the grain market, which is another huge export from there. Take a look at aluminum. Tight situation on the aluminum market. Russia accounts for about 10% of global aluminum exports. Rundell, the largest producer, has already experienced sanctions from the US. 6% of global production is from them. The price is about $3,500 US per ton. Global inventories are at their lowest level since 2007. So that's quite an interesting thing to keep an eye on. Tight energy situation in Europe does not allow to produce at a profit. Energy alone to produce 1 ton of aluminum costs more than the aluminum itself on the market. Data from France, but the situation is similar for the rest of Europe. So this is what I was talking about earlier with the oil prices and how if they're not profitable, it's not, if it's not a certain level, it's not profitable to produce. Here we are with the aluminum market as well. So keep an eye out for that market as well. And sanctions affect the aluminum market. As I said, Rundell is one of the largest aluminum producers in the world. The global isolation of Russian companies' asset continues. Rio Tinto announces it will not supply raw materials to its smelter located in Ireland. There was similar turmoil in 2018 when the U.S. imposed sanctions on Rundell and company founder Oleg Deripaska. The number of canceled warrants relative to the total aluminium stock is relatively small. In 2018, the number of canceled warrants increased strongly in response to the sanctions. The aluminium price rose strongly and scored a correction. The market does not appear to be tight in nickel. The number of canceled warrants reached over 50%. However, stocks remain low, and the willingness to take stocks out of the stock market may increase in the event of a further blockade of Russian companies. So that's that for the presentation. Thank you very much for following this far. Hopefully this was useful. We covered, obviously, a main focus was on oil and gold. However, there are some other markets that are really heavily impacted by this ongoing conflict. Keep an eye also for the COVID situation evolving in China, as they are a massive source of demand. So yeah, if you have any questions, let's move on to the question and answer section. Hopefully that will be able to clarify some of the things I've discussed today. And if I'm looking to the right, it's just because I'm looking for questions. So hello again, Caroline. Thank you for being
Thank you so much for that incredibly detailed explanation on how to trade gold and oil. For anyone who perhaps wants to rewatch or who only came in for part of it, then just a reminder that XTB is recording the whole event and it will be available to account holders. So if you do want to get yourself a copy of the recording, then make sure you open yourself an XTB account. So are you ready to start answering some questions? We've got a few coming in.
Yeah, absolutely.
Okay, wonderful. So first question we have is from Azura, who's asked, how long do you expect the volatility to continue in the oil market?
Excellent question. Thank you for your question. So I would say that the volatility can continue as long as there is uncertainty in the market. So as I mentioned at the towards the beginning, volatility isn't necessarily brought by good or bad news. It's brought by unexpected news. So the more the situation becomes uncertain, the more volatility can continue. Once things start to stabilize, which is in the best interest of most people in this market, then volatility might drop. But at the same time, as we've seen now, more positive news to bring the price back down, any spark of any sort of unexpected news, whether it be positive or negative, could see it either go down or up based on that. So I would keep an eye out for the fundamental factors like news to kind of establish how long that could go. How long that could go is really until things start to stabilize. But we've seen after we're done with COVID, we got into this. After this, who knows what might happen. So, I would hope that volatility, it's a good thing and a bad thing. If you're trading, it's a good thing. If you're, living everyday life, higher prices are not the optimal thing for you. So I would say, as long as we keep seeing unexpected events happen, especially the bigger the unexpected event is, the more volatility and vice versa. So hopefully, that answered the question. I wish I could tell you the future, but I can't do that.
I think that answered it very well. So the next one is gold still a safe haven currency in times of crisis? And what can be the long-term effect of what's happening on gold? Obviously, you can't predict the future, but...
Well, I'll try my best. No. Gold, yeah. We saw that gold during the COVID pandemic really lost some of its favor. We saw a huge boom in some other assets. But during this crisis, we saw gold actually spike in price. So we saw it reach near its all-time high around $2,070. So on that aspect, it does seem like gold has retained its safe haven status. Now, overall, price stability on gold seems to be quite intact as well. So in my estimation, I would say that gold has retained its safe haven status for the time being. We saw some increase in the demand for crypto as some sort of an alternative, safe haven, let's say, but that is too unstable at the moment to really rely on. Some other assets like the US dollar tend to be a safe haven kind of result. But at the same time, gold is the main physical asset that is the safe haven, traditionally speaking, for most people, if you ask them. And really, it is also because a lot of central banks are backed by gold. So it would be in the worst interest of all these central banks if gold just stops having any value as a safe haven. So for the time being, I say that it probably is still a safe haven. The long-term effects of what's happening in gold could be definitely a potential increase in demand, because what we are seeing is in times of crisis, gold spikes. However, if people expect a more kind of laid back situation where we see a little bit slowing down of the conflict or resolution of the conflict, less volatility on the market, then gold loses its appeal a little bit, because practically speaking, gold doesn't have that many uses. As I touched on earlier, it doesn't have that many uses like silver, aluminum, nickel, or platinum and palladium, which are also precious metals, platinum, palladium, and silver. But they have many more uses, particularly with where we're moving in the electric vehicle direction. A lot of these metals are not just precious metals, which are used for that aspect, but they're also used very heavily for the production of batteries and the electric vehicle components.
Okay, and we've got another question from Toba from YouTube, who would like a bit of fortune telling here. So what's your forecast for the price of natural gas?
Now, thank you for your question, Toba. So the forecast, obviously, this is not investment advice, so this is not a prediction necessarily, but I would say to keep an eye out for the supply resumption from Russia, because Russia has such a huge part in the European market of supply of natural gas. We touched on in the presentation on a few different ways where Europe could get some of that natural gas from. Liquid natural gas is a huge export of Russia into Europe. It's not like they're going to stop using it overnight. What's going to happen most likely is that any further disruption, potentially even with some counter sanctions from Russia, could have a significant price impact on the price of natural gas. Now, if the conflict is resolved, that doesn't mean that overnight these sanctions are revoked. So again, we could be seeing some extended volatility on the price of natural gas, just because of the fact that the uncertainty, as I touched on earlier, is tied to the uncertain nature of what happens even if this conflict is resolved. So keep an eye out for that. Natural gas is definitely going to be one of the more interesting markets, along with oil and gold and other precious metals as well. So all these commodities, because they're so tied into Russian exports and Ukraine, obviously, as a result with wheat, could be seeing a significant increase in volatility, or at least a continuation, the more unexpected news we do see forward. So as far as the price, obviously you have to account for that drop in supply could have an impact. The increase in supply could have another impact.
So I've got another question from Ellie, who's asked, is there any news relating to the liquid natural gas line from Israel, Cyprus to Europe in order to replace the Russian liquid natural gas supply?
So yeah, I mean, that's a very good question. Thank you, Ellie. So as far as that is concerned, as I mentioned, with also the Iran deal for oil, the Venezuelan deal for oil, where Venezuela would be selling to the U.S. and the U.S. sell their oil to Europe. Same with Iran. Iran would have access to the market. Same thing applies here. Even if we do move forward with an alternative pipeline, these things don't happen overnight. So I wouldn't expect the supply to increase, even if they do have a supply line established from Israel through Cyprus into Europe. That doesn't happen overnight. These are long-term contracts with natural gas. So it's something that can be established, but it cannot really have an impact from one day to the next. So this uncertainty can only be countered with certainty, which can only be countered with longer-term effects of these exports production. So yes, it might be a prospect moving forward, but I don't think it's going to be something that's going to happen within the next couple of weeks, even, or the next month or so. And even if they did, like I touched on, even with the increase in production, if OPEC increases exports, that's one of the most direct things that can happen. But even if, let's say, a lot of oil production is started in the US, whether it be a pipeline, whether it be more oil rigs, these take time, because oil has to be dug out from the ground, then refined. Same with natural gas. It has to be liquefied, then deliquefied, so turned into gas once again. So this takes a lot of time, and I wouldn't expect that to have a significant price impact, besides the initial news having potentially a positive impact as well.
Thank you. So I have a question for you.
Please.
What are common mistakes that you see when trading commodities, when new people start trading commodities?
That's a great question. Well, I think that people don't follow the news enough. They don't tie in the correlation between what's happening in the real world to what happens in commodity markets. That's what makes them a little bit quite interesting for me, is the fact that I can, and it doesn't take like a spark of genius or anything like that. It just takes a little bit of just background knowledge of who is producing these goods and aspects. Just take basic laws of supply and demand in the market that we all live by. and apply them to whatever market you're trading. So if it's gold, who's buying gold and who's selling gold? Take a look at that, and take a look at the situations in which gold becomes more attractive, or even more practical, oil. Who's selling oil? These are the countries that are selling oil. If something happens in that country, try to infer what's going to happen potentially to the price of oil and take a position. Now, obviously, take a look at the charts, use the charts to establish entry points. Risk management is essential. That's something else that I think is a overlooked aspect of trading, is risk management, taking profits, stop losses. Cover yourself when you trade, because you don't want to trade blindly and just hope for the best. You have to have some sort of a contingency plan. But I would say, being aware of the fundamental situation is a key thing that can keep you in the markets longer. And ultimately, being in the markets, nobody has 100% success rate. There is no such thing as a market that keeps going up or keeps going down, or somebody who makes 100% of their trades. Even successful traders are traders who make, maybe they are successful 60% of the time or something like that. But because of their risk management, they're able to make money consistently. And consistency is the key to this market, and any market really you're trading.
Thank you. One last question before we head to a break. So do you have any advice for trading indices during times of extreme volatility?
Yeah, I mean, obviously indices are a little bit more complex because they are made up of so many different companies. But at the same time, take a look at what we saw during COVID, where certain companies, boomed. We saw the boom of digital companies like Zoom, Netflix, Amazon, and so on, because of the actual demand. So once again, take a look at the general situation of what's happening, and try to go and find, because you can find this information out there. It's out there. You can hear about these companies. You can research them. You can do a lot of research, but even some superficial research can show you. And if you just apply some logic to, let's say, the situation that we're currently in. So let's say that we have a situation where everybody's at home. Nobody's going to be driving their cars, so maybe car stocks go down, or plane stocks go down, or airline companies, as we saw. And on the opposite, everything that people do at home starts to have more demand. So once again, tie in supply and demand into your looking when you're looking for stocks, because at the end of the day, indices are made up of individual stocks. Particularly US indices are very much impacted by their top 20 stocks. So keep an eye out for the most influential stocks and their performance, and don't branch out too much. But at the same time, we can see in the period of increased volatility across all markets, it's just tied to what the current tide is. And nothing goes up forever. Although statistically, if you look at the S&P, for example, it is going up forever. It just has times of corrections, and corrections are normal in markets, whether it be 20, 30%, these things happen. Nothing goes up indefinitely, or it goes down indefinitely, generally speaking, unless it's going to zero. At that point, it's a different story.
Great. Thank you so much. We've got so much valuable information there. So we really appreciate you speaking.
Thank you very much, Caroline. Thank you. Thank you. And thank you to everybody who's following us. Of course, it's my pleasure to do this. Hopefully I've added some value and answered some of your questions. So I wish everybody all the best with their trading, and all our best. I'm very grateful to our speakers as well, other speakers who are with us today to share their opinion. I'll definitely be keeping an eye out for that. And thank you for doing this as well, Caroline.
Thank you very much. Enjoy the rest of your weekend.
Thank you. And you as well. Have a great day.
Thank you. We are going to be taking a 10-minute break now before the next session, excuse me, where I'm going to be moderating a roundtable discussion with some TikTokers in the finance niche. And we're going to be coming up with the rules to staying safe when learning how to trade using social media. So I will see you in 10 minutes time.
Successful manager, smart investor, nice guy. Who do you want to be? Do you want to have the knowledge and intuition that always gives you the advantage? Do you want to have at your fingertips access to the latest technology that lets you be one step or even a few steps ahead? To have stories of all of your victories and defeats, but always take lessons on how to improve. To feel the emotions, the excitement, because in the end, you see your strategy is working. Do you want to be like me? You can when you trade with XTB.
Welcome to this XStation 5 mobile app tutorial. In this video, we will show you how to find the markets you want to trade and how to create your own market watch groups. Once you are logged in, you will see that you will automatically be on the trading tab in the bottom left hand corner, and all of the markets that you can see here will be from your favorites tab. If you can't see the market that you want to trade in your favorites, then to search, simply click on the search bar in the top right hand corner. This will then give you access to all of the different markets you can trade at XTB. By clicking on each market, you will then be presented with different subcategories. For instance, if you click on Forex, you have major, minor and emerging, and then you have the list of different markets for that category. To add a market to your favorites, simply click on the unhighlighted star. It will then become highlighted, indicating that it has been added to your favorites. For indices, you have Americas, Asia Pacific and Europe. So if you click on Europe, it will then present you with all of the different European indices that you can trade at XTB. If you still can't find the market that you're looking for, then you can use the search bar at the top. Let's, for instance, say you was looking for a stock and you clicked on stocks and you clicked on UK. You couldn't quite find the market that you were looking for. So what you can do is use the search bar at the top. So if I type in Rolls-Royce, it will then find that market for you. Once you click on the market that you want to trade, you will then be presented with this screen. And for more information on this specific market or this company that you've chosen, click on the information button in the top right hand corner. This will then present you with the basic information such as the commission, the leverage, as well as the market hours. Now, to create your own market watch group, simply click on the settings button in the top right hand corner. Then click on the plus button again in the top right hand corner. This will then allow you to create a new watch list. Once you click on this, you can then call it, for instance, let's go Forex. You have now created your own Forex group. Now to add a market to this new group, click on the group, then click on add instrument, click on Forex, let's go with major, and then on the right hand side, you'll find the tick boxes. Now for each market that you want to add to this new group, you can add them by ticking them. Again, if you can't find the market that you are looking for, you can use the search bar at the top, and then it will find that market for you. To view this new group that you have created, we have to go back to the home screen. And then as you can see at the top, where you had your favorites, you now have your new Forex group. So if I click on Forex, these are all of those currencies that I've added to that new group created. As well as your own personalized groups and favorites, we also have a hot market list. This is a list of the most popular markets traded by clients at XTB. You can add these markets to your favorites by clicking on the star. By viewing sentiments, you can dive deeper into the markets traded by XTB clients by seeing the percentage of buyers versus sellers for each market. Currently, it is selected on sellers, and we are looking at FX, CMD, which is commodities, and IND for indices. If we take natural gas as an example, you can see that 62.57% of clients that trade with XTB are short this market, speculating it's going to go down, versus 37.43% that are long, speculating the market is going to increase. Now, if we click on sellers, we can change it to buyers. And on the flip side, let's take Platinum as an example. 68.1% of clients that trade with XTB are long this market, buying, speculating price is going to go up, versus 31.83% of clients speculating price is going to go down. This can also be filtered by different markets. So if you click on this icon here, you can then select or deselect the markets that you want to view. The next tab is Top Movers. This tab will show you the biggest winners and losers for a specific time period, which can be filtered through 1 day, 1 week, and 1 month to show you the most volatile markets for that period. So currently it's set at winners and 1 week. So if you click on 1 week, you can then change it to 1 day and 1 month. If you click on IND, which stands for indices, you can also then filter it for other markets such as Forex, commodities, stocks, ETFs, as well as all. If you click on winners, this will then show you the biggest losing markets for that time period selected. Thank you for watching this XStation 5 mobile app tutorial. Before you go, why not head over to our education tab and access free market education, where you can learn different trading strategies, market analysis methods, and the psychology behind trading, all for free. To do this, simply click on More in the bottom right-hand corner, then select Education at the top, and then here you have access to all of the free market education at your disposal. Lastly, don't forget, as a live account holder, you also have access to our free mobile trade alert group via WhatsApp, as you can see here, which will give you access to key technical levels and breaking news, expert trade ideas straight to your phone, digestible analysis in real time, and FX trade recommendations from major investment banks such as Morgan Stanley, Barclays, Deutsche Bank, and more. For more information on these services, please contact your account manager.
Welcome back to XTB's Masterclass. We are now on the roundtable discussion part of the day. My name is Caroline Rundell, or on TikTok, my name is Trading Angel. And when I'm not making TikToks about trading, I'm also a journalist at the BBC. So the topic which we're going to be discussing on today's roundtable is one which I think is really important, and that is to do with staying safe when learning about investing on social media. So I'm really, really excited because I'm joined by such a great group of people today. So first of all, we have Annika, aka FinPact, who has a degree in accounting and finance. She has a great YouTube channel where she talks an impressive detail about crypto and NFTs. And if you check out her earlier TikToks, she also does an impressive amount of accents. Welcome, Annika. Is there anything else you'd like to tell us about yourself?
Hi, yeah, it's lovely to be here. So I joined the sort of social media journey about 7-8 months ago when I left my job. I worked at Morgan Stanley in investment banking, and I worked on the buy side at a private debt fund. And I fell in love with the power of social media and how you can reach audiences and teach them stock market basics as well as cryptocurrency basics.
Oh, thank you so much. It's so nice to have you here today. Next, we also have Timothy Paul, aka Temper Time, who is pretty much TikTok royalty with nearly 500,000 followers. Welcome. I believe
Hi,
you
Caroline.
also have a degree in accounting, or you are an accountant, is that right?
Yeah, so I actually have a degree in economics and finance, and it was kind of around about like third year of university where I decided I think accounting was the way to go for me. So I currently am a training accountant at Deloitte in London. So yeah, that's can be challenging, but it's good fun as well. Yeah. So yeah, thanks for having me on.
Thank you so much for being here today. It's so nice to have you here. And finally, we have Poku Banks, who has over 300,000 followers on TikTok and more than 8 million likes. He creates TikToks about finance. And before we start, I would love you to do your
Hey, baby. Let's get it.
There we go. Now we can get this started. Now you've done that. Is there anything else you'd like to tell us about yourself before we get started?
Yeah, so I'm studying at university, finance, accounting, and management. And again, I just want everyone to learn about personal finance and investing because, again, I just want to take your lives to the next level.
Oh, amazing. Okay, so we are going to be coming up with the do's and don'ts of learning finance using social media. So how to stay safe. Obviously, part of staying safe also means avoiding people who are unsafe. So we're not going to dwell on that, but we are obviously going to touch on it. What I thought would be really fun and maybe a little bit cheesy is if we could come up with a really catchy acronym for the do's and don'ts of staying safe. So I was thinking maybe if we could get 5 keywords that could fit trade. So a word beginning with a T, a word beginning with R, a word beginning with A, a word beginning with D, and a word beginning with E. So you don't have to think about it right now. We'll discuss the matter, and then hopefully towards the end, it will all come together and we can have a really catchy acronym for people so they can remember how to stay safe using social media. Sound good?
Sounds good.
Good. So let's just go, start at the beginning. So Annika, I'm going to start with you first. What made you decide to become a finance creator?
Well, I always liked, so it's quite an interesting question. I think markets are very unconventional, and trying to make it valued a certain way, the way a bank does, I don't think necessarily is the way forward. I think there are very stringent procedures, whereas I always thought markets were psychology, a sentiment, not a one-fits-all strategy on thinking what's a good stock and what's a bad stock. So when I thought of it that way, that's when I thought, wait a minute, let me teach it the way I see it rather than just the way Wall Street teaches it. So that was one of the things. And the second thing was wanting to reach out to more women and teach them that about investing, because there is a disproportionate amount of male to female investors.
Yeah, absolutely. I've noticed that as well. Timothy, same question to you. What made you decide to become a finance creator?
Wow, so I graduated from Sussex University back in September, well, about August 2020. And I was due to start my accounting job in September, but it got delayed due to COVID. So I kind of had like 4 or 5 months of just kind of not having much to do. And I downloaded TikTok kind of just randomly. And I saw, other creators on there like Poku Banks, the man himself, and a few others. And I just decided, what, I think that I have my own story to tell with kind of what I've learned and the way I see kind of the financial markets and the kind of my own trading journey that I've been on, specifically in like the Forex industry as well. I thought maybe, I could kind of provide some value in certain areas, specifically around kind of like the younger generation, because I feel like there's such a like an educational gap. Like there's such a kind of a gap to fill, I think, in terms of just educating kind of the younger generation on like basic finance concepts. And like the more like I make the videos even now, the more I realize how much people out there just don't really know. So I think it's about bridging that gap and kind of filling that demand for me that I kind of see as like my long-term goal within like being a finance influencer.
Yeah, thank you so much. Your videos are incredibly informative. I've been watching them and they've got a lot of value to them. So I think that they're very helpful to young people learning about finance. And Poku Banks, can I ask the same question to you? What made you decide to become a finance creator?
Yeah, so for me, what it was, I was leaving sixth form, so year 13, and I was realizing, wait a minute, I don't know anything about investing. I know nothing about debt. I don't know anything about how I can take myself to the next level or start a business. I only knew that through experience. So I realized, wait a minute, if I'm leaving school without these things, then that means everyone else is too. So I thought, you know what, let me start researching and learning and digesting all this information online from podcasts, books, and mentors. And then it got to a point where people in my area were asking me for help. And I realized if they're asking for this, I think the rest of the world needs this. And the problem with today's day and age, people have short attention spans. So people won't want to watch long podcasts or read long books. So I thought, you know what, if I can read this and then digest it in my way to make it understandable for the young generation and for my peers, then it'll make the world a better place. So with me, I just saw the gap in the market where not a lot of people learn this in school. So I'll be that person to teach them and show them online.
Yeah, absolutely. And what was saying back to you, Poku, what was the best piece of advice you were given when you first started your investment journey?
Understand that losses are a part of the game, because the thing with investing, right? Okay, especially with smart kids in school, they feel like they need to pass all their exams and get the top grades. But when they get into trading or investing, and then the market tells them they're wrong, it's hard for them to comprehend that. So when I was told earlier on my journey that losses are part of the game, it builds with wisdom and you learn from your mistakes and you refine your skill, you refine your strategy. That really helped me when it comes to handling losses, because some will think, oh, I'm losing, this ain't good, let me stop. But you need to understand it's a journey, it's a part of the game. So yeah.
Yeah, that's a really good one. Same question to you, Timothy. What was the best piece of advice you were given when you first started learning about investing?
Yeah, I think for me, it's very much, I agree with what Pokey said, like not to rush the process. It is a journey. And I think everybody's journey is individual to them. So I think that a lot of time we get caught up in comparisons and comparing to others and how quickly they manage to, maybe become profitable and stuff. And I think that really focusing on you and how you can progress and just compare yourself to where you were a month ago, 6 months ago, a year ago, and how far you've come since then, I think is the most important thing that I wish I knew that I did. Well, something I wish that I did more when I started out, for sure, because it can be tough, and it can also be like a lonely game being a trader as well. So I think that it's key to just kind of keep focused on what you're trying to achieve and your own progress that you make.
And do you think that there's maybe unrealistic expectations for how quickly people can expect to learn trading? Because I think, and that was something that you kind of mentioned, Poker, with everyone's got a short attention span these days. And I think the one thing that I've noticed is everyone's asking me, how quickly can I make £1 million? And I think, you have to learn how to trade first. It's like if you were going to be a doctor, you don't say how quickly until I can operate. You sort of go through the process first, and that takes several years. So do you think there's unrealistic expectations for how quickly people can learn the process?
Absolutely, yeah. If you compare it to getting a degree, it takes 3 years, sometimes 4, sometimes 5. So there's no reason why you shouldn't apply that same kind of criteria of timeline to learning a skill so vast and extensive as trading and investing, in the world of finance.
Yeah, thank you. Annika, what was the best piece of advice you were given when you first started learning to invest?
One of the best pieces of advice I was given was having a longer time horizon. So having your portfolio of short-term trades, but also having long-term trades. So and not panicking when you see market volatility, because historically I was shown this graph that the S&P 500, even during the recessions, even during every crash we've ever seen, it's still higher, so seeing those dips and not panicking and holding tight and believing in the fundamentals of the company you've invested in, especially if you're going long on something, then making sure that you just stand by it.
So can I tell us, what's your investment style then? I've seen you do a lot on cryptos, you do a lot on NFTs. Do you also invest in stocks? Are you more like a long-term? Yeah.
Yes. So I actually also film. I'm a market researcher for Tip Ranks and an anchor for Tip Ranks TV. So I cover stocks on that channel and I do cryptos on mine. So I invest in both. So for me, I think it's so important to have a diversified portfolio and having exposure to every asset class, because I think when you have exposure to every asset class, you're more risk proof when you see volatility. So in my portfolio, I have gold, and with the Russia-Ukraine crisis, gold is a safe haven asset. Money's flown into my gold assets, but my other assets have gone down. So it's sort of hedged my portfolio, and I'm so grateful. Even though the way most people want to do it is that they see market runs in the crypto markets, all-time highs, and they're like buy, but actually, I say that's when you sell. When you see all-time highs, and buy times like now when people are scared and afraid. So basically my philosophy is going against your emotional instincts where you want to buy and FOMO in at top prices, and actually buy when people are scared, because then you will have the least amount of risk and the highest possible amount of return when the markets do go back up, and they always do go back up.
Yeah, absolutely. I mean, the next question I'm going to ask, I mean, it sort of ties in a little bit with this, because obviously we've been talking about how it's a process. You have to take the time to learn. You can't expect instant results. And what do you think are, so I'll start with you, Annika. What do you think are the top mistakes that traders make when they first start? And obviously you've touched on it a little bit, but do you think there's anything else that, people need to be looking out for when they first start out, in their first year or so?
Yeah, so it depends on such a number of factors. So, for example, if they're investing in something, the first one I've already mentioned, what's their time horizon? Are you investing in a company that has a great team, but maybe they're not even producing revenue? Then you should have a longer time horizon if you believe in what they're going to do. Basically tailoring your strategy depending on your trade, your investment. So I've done a lot of short-term trades in crypto stocks. When new launches take place, they have a lot of hype. So I trade in on that hype and then I exit quite quickly because I know those sort of hype bubbles are very volatile. People don't do that. I think people are overly optimistic, and it's important to know that not every project will be a long-term investment. So differentiating that between which one will be your short-term trade and which will be your long-term investment is so important to make profits. And you only learn that over time. I mean, I remember trading as a newbie uni student, not really knowing anything I was doing and making a lot of losses in the pocket money I was getting, which was not a good idea. And then as time went on and, I worked in the finance sector, I researched a lot, and I started developing my own investment philosophy. That's when I started making successful trades, and I had a system in place to ensure that I separated my long-term investments, my short-term investments, and had a diversified portfolio.
Thank you. Same question to you, Poco. I mean, what do you think are the common mistakes? I know you touched on it a little bit, but what do you think people are making in their first year when they're starting out their journey?
I feel like blindly copying and trying to copying other signals or other investment ideas on social media. The reason I say that is because, number one, everyone has different pockets, everyone has different trading accounts. So for someone that may be a well-seasoned investor, starting off with 6 figures, their 5% a year is great. But then if someone's starting off with £100, that 5% a year doesn't look too great. So I feel like people need to understand that people are in different stages. So when you're copying someone blindly, they may see something different. They may be looking for the long term. So they don't care about the short-term volatility. Whereas you can't sleep at night when you're down 10%. So you need to understand that everyone looks at the market differently and everyone has their own different risk tolerances. So when people come in, even me, I'll copy people blindly. Oh, he's investing in this stock, let me do so too. Yeah, he's in it for the long term. I'm just trying to make a quick flip. So I feel like you have to understand that everyone's in different stages in their investing career, and you have to apply that and compare to your own strategy and how you want to do things.
I'm really glad you said that about signals, because actually I think that's a really, really important part of this. And I'm going to go on to that in a little bit, because I think that, I don't know about the rest of you, but I feel like I get so many messages from people just asking me, A, can I trade their money for them? B, can I send them signals? And I just personally think that part of trading well is actually having the information for yourself rather than just having someone else do the work for you. Because as you pointed out there, what's right for one account is not right for another account. So, and I think a lot of new traders don't really get that. They sort of see the holy grail to making money as a trader is just copying other traders.
Yeah. With the signals, I just see as like, if you are going to take signals, at least use the signals to learn from it. So, oh, he entered at this price. Why is that? Go back on the chart and check it out and try to analyze and see if you could have predicted that. But if you're taking it blindly, you're just relying on someone who can stop at any time and stop your money coming in.
Yeah, I do agree that signals have value in some way. And the only value that I see in them personally is that when a trader first starts out and they really don't know anything and they don't even know how to place a trade on their, on MT4 or whatever they're using, then I would say, sure, follow signals just to, get a prompt as to what to do. Get yourself used to putting in a stop loss, get yourself used to how the markets move, but don't expect to make money from them. I mean, would everyone agree with that? Yeah. And so Timothy, Tim, I'll be less formal. What do you think are the biggest mistakes that new traders make when they first start out?
For me, I think the biggest mistake I see traders make, anyone getting into the industry, is they chase the money, they don't chase the skill or the knowledge.
Yeah.
That's the problem I always see. It's like you see some investor who maybe has like a 6-figure account, they make a 2-3% trade, it's a few grand in the space of like an hour or 2 hours, and it creates a glamorous lifestyle that just isn't realistic for everyone else, or for, you know, for a beginner who doesn't have that kind of capital, and they think that could be possible for them. And like, it kind of ties back to the signals. That's why signals, I think, seem so attractive, is because they think they want to skip the part where they kind of gain all the knowledge required to get to the point where they want to get to, and they see it as an easy route to just make some money. So the real problem is, just not focusing on the fundamentals of what you need to learn first before you actually invest a single pound. Like, you shouldn't really be investing if you haven't done your research into, say, the company, or, you know, its fundamentals, its long-term projections, and its potential for the future.
Yeah.
So, yeah, I think that's the mistake that I really see.
Yeah, I mean, everyone's kind of touched on the realistic aspect of it. I mean, what do we think in terms of, I mean, obviously, you see all these traders or financial influencers, and they're flashing their Lamborghinis around. You say to someone who thought, you know, who believed in that? So I'll start with you, Annika.
So when I see people flashing their lifestyle as a way to sell, I think that's ethically wrong, especially given that they know that the audience will not more often than not be able to do the exact same overnight. Like, they're not going to make a couple million overnight. I mean, if they do, it's one of those newspaper stories that's rare. So I think when they do the lifestyle and they flash it, and it's giving people unrealistic hope and trust on them, which is dangerous, because you don't know their story. They could have gotten lucky. They could have known the right person at the right time, heard something, made one right call. I don't think it's not the foundations of their entire reputation, but people will trust that because people will see someone with their flashy Lamborghinis and think, right, let's trust this person who might not even have any education in finance or any experience, but happen to have got in at some right time or made the right deal. You know, I mean, it's a lot of YouTubers that started off in the beginning in the financial sector. Most of them don't have financial experience, but because they started early, they're giving a lot of advice by showing, look, we've made it. This is how you can.
Yeah. And I mean, do you think that these people who are sort of doing these flashy lifestyles, do you think that that really is the result of trading? Or do you think that perhaps that is from, as you say, maybe it was inheritance? Do you reckon they got out loans? I mean, what's your view on that?
Yes, so I'd say I've probably figured this out as time went on in my YouTube journey. So I used to watch these exact people. And when I started YouTube, I realized that a lot of these people have a business system in place. They aren't just making money from trading. They have Patreons, they have sponsored deals, they have all these other ways, which gives them a lot of capital to either make a trade they really believe in or invest in a portfolio. And then suddenly, to the masses, they're showing a portfolio of millions and millions, but actually they got that through a business system, their social media enterprise and showing it off. And the traders that are in social media, those ones, well, they're not exactly flashing their money, are they? They are usually quite low key in their bedroom or in their office trading away. So I think those are my thoughts on that.
Do you think you've got a responsibility as a financial creator to give a realistic, view of your life?
No. So yes, but I don't show my life. Sorry,
Yes.
I don't show my
life.
I think it is a responsibility because people put your trust in you. In short, it's dangerous. Yeah. I personally do not show your life, your money. I just make about the facts. It's not a portfolio. don't even do those videos showing how much there is in my portfolio or anything like that. But I think that's a personal preference. Some people capitalize on that, which I think is dangerous, and they show off their lifestyle to gain trust. But that's not the way I've ever wanted to do it.
Yeah. And I mean, same question to you, Poco. I mean, do you think as a financial influencer or someone in the, finance niche on social media, do you think that it's a responsibility to, how you choose to portray your life or your lifestyle? What's your preference in this sense?
Yeah, I definitely feel like I have a responsibility because people may look up to me and they want to emulate me and whatnot. Me, however, I like to fall through with the personality, not the personality, the truthfulness and the honesty, and I like to relate to the audience. So different to Anika, I'd rather show a little bit, oh, I'm doing this, I'm buying this, I'm going here, just to show you guys that it's possible. And I feel like honesty is what sells. Again, it is personal preference, and but I feel like I'm trying to build that relationship with my followers. It's not great to sell a lie though, so it's not good to act like, oh, this is very easy. You gotta show that it's really hard, and you gotta show the truth of it. So as long as you do that in moderation, I think if you have that balance, you should be fine.
You are right. You are right. I do think there's an element of hope you give when you show a little bit of your lifestyle. I do agree with that. I think the only reason I don't is because I'll show them maybe, okay, this trade made me XYZ, or I made this investment and it did so and so about that particular investment. But I think the lifestyle thing, I also feel that as a woman, I'd get judged a lot already. I already get judged in the financial industry differently, even though I've got a degree and worked in finance. I feel like if I suddenly started showing off my lifestyle, I get very terrible comments that a lot of the male counterparts of in my field don't get. I get comments on how I look rather than the information I'm talking about, or, oh, you just shopping, or just very sexist comments. And I think that's probably why I've shied away from showing anything that's to do with lifestyle.
That makes sense from that point of view.
Yeah, I understand that as well. I've chosen not to for the same reason. Sort of also get people asking money. I try to responsibility as a creator. Do you think we have one to?
Just going back to the point about what always a thing that you really have to come to learn, and it might be you might learn that the hard way, but it is something that you will always learn. My forex kind of trading and stuff, that's not something that I've made a lot of content about personally, because I feel like I want to be at a level where I'm confident to really give out kind of more advice and stuff before I really do it. So I think that there is a level of responsibility to also show the ups and the downs. So I would never follow anyone that only shows the wins, the flashiness, the upside. They have to also show the downside too, because they both come in tandem. You can't get one without the other. So from that perspective, I think it is good to show your lifestyle, as long as you are showing it in the right way, and also kind of to make sure that you're at a point where you feel like you've accomplished maybe a certain amount, and you can kind of use that and show, yes, it is possible, and you can kind of share your journey. So I think those are the two things that I would say about that.
Yeah, I agree very much. And this next bit is going to be a little bit awkward, but what do we all think about being paid for sponsored posts as financial creators? I'm sure we've all accepted money to do a sponsored post. Do you think there is a conflict of interest there? Does anyone have an opinion on this?
It depends. I definitely have an opinion on this, because my YouTube business runs on sponsored posts, and I think it's about being selective on which ones you do. and being clear to your audience about which ones have risk. So any sponsored post I've done, I've always said what I truly think of it, but also if it is a risky one, which many of them, especially in crypto, can be, especially new launches, even if they're credible and have great teams backing them, I always say, look, it's a risky one. So make sure you don't invest anything you're not willing to lose. That's just the nature of the markets. And being transparent about that, then you're giving them the option to be like, look, I've been paid to talk about this, but these are all my honest opinions on it. You can take that as you may, and I'm not a financial advisor, which I'm not. I've worked in finance and I talk about what's worked for me, but it's important that they're just seeing your experiences. A lot of the sponsored companies I've actually invested in myself, or I think their projects are really cool. And even if they're not so much as cool projects and they're in the meme coin hype, I've always said to my followers, meme coins are very risky. That's not to say you can't make profits, but treat it as a fun little game. Don't put your life savings in that, because that's dangerous. So I've always said that. And that's why I think when you do it that way, because at the end of the day, if content creation is your full-time job, you do have to also earn a living. And how can you do that in the most ethical way is by being completely honest about it. And if you don't like a company, just don't take the deal. I've done that many times. I see a company, I'm like, this is rubbish, I'm not taking it.
Yeah, I'd say about 90% of them are.
Yeah.
So what does anyone else think? Do you have thoughts on this, Tim, Poku?
Yeah. I would say I definitely learned, I think, early on when I first started to get big on TikTok, particularly, and the deals started coming through. I could admit I agreed to. I won't name the company for obvious reasons, but yeah, I agreed to a deal it was a crypto trading bot or something like that, and I agreed to the deal before I really researched them. And once I came to making the video, I realized, it's just not something I should have done, basically. And I remember getting a message from some people after I posted it saying, I've just done some research. Their reviews are terrible on Trustpilot. And I was like, yeah, this is a position that I don't ever want to be in again. So I definitely learned from that to really do my due diligence, especially when it's around, like Annika, you said about the crypto being such high risk. It's really important that you do research these companies beforehand. So yeah, that's one thing that I've learned along the journey.
I'm laughing because I know exactly which company you're talking about. Yeah. Because I've gotten multiple emails, and it's quite easy to tell from what's a scam and what's legitimate, because now I think as social media influencers, when I get emails, I look at the ending of the email, that's a big giveaway. That's dangerous. I think there are loads of encrypted emails you get messages from, and also they give you these weird zip bags to open, and I don't know, they might have viruses. They ask you to put in details, your wallet addresses. Basically, they're trying to steal money from you. And I have a group of YouTubers that we're all in the same group chat, and we message and we say, guys, is this legitimate? Is this a good deal? So it's good to talk to others and be in a community, because it's funny, that chatbot one, I got another message from them yesterday, so I blocked them.
Yes. Yeah. I wish I'd have done the same. That's all I can say. Yeah. But we are learning on the job at the end of the day, so it was I guess it was kind of naivety on my part, kind of as I was starting out on my journey, I guess.
Yeah, I think everyone's been through that, because you have to learn the hard way almost, don't you? I mean, this brings me quite nicely onto, what do we look for when someone approaches you? What do you look for as a safe company to work for or to endorse? What do you think, Becky?
Well, I look for again, I look for reviews, like Tim was saying. I look for reviews. I look for familiarity with myself, because I'm also in the industry. So if I've heard of them, then it's already a bonus. But if not, I go ask some of my friends, have you heard of this company? What do you think of it? I'd say that. And just in terms of when they come in contact with me, it's just familiarity with my own content. I've noticed that with some emails, you can tell they're sending out a bunch of emails to a bulk, like a mailing list, whereas like some that come to you, oh, hey Poku, I watched this video, I like it, and they quote certain things from videos, so they're watching. That's when okay, they have a full-on interest. And furthermore, I like companies that are doxed, so essentially like the founders, their whole faces online, their name, you can find out who they are, so they're unlikely to pull any rug pulls or whatnot. But for me personally, I think I stay away from being paid to promote any asset. I just feel like, for example, like some crypto coins, I just feel it's just a rough industry. And as we'll move on to later, you know, some people have even been sued, you know, Kim Kardashian, Floyd Mayweather. So it's just a tricky situation there.
If you got an email from someone and you were to go, no, I don't want to work with this person, what would be in that message that would make you go, red flag, danger?
It's just more like the way it's laid out. Like Anika was saying, the way it's laid out, the font.
The font. What font don't you like?
No, it's just like you can just tell, like it's just some weird, not a weird font, but it's just different to normal email. You know, I don't know.
Sometimes if it's like in italics, it looks like it's been copied and pasted from somewhere, and you can just tell straight away.
And you have like
loads of emojis.
You have random numbers. You've got some like text in I don't know, Russian or Chinese. I don't know, all random numbers. And also, I think I've any of the emails that end in like, I can't say, but some dodgy endings. They're not, I mean, I don't know if I don't think every email from that ending is dodgy, but just, some of them tend to be like that. And generally my email box filters out the junk, but I still get some through. And I look at how emails are structured. Is there, a sign-off message, like a logo and a social media manager? Then it's probably from an official company. But I've also had deals from very legitimate companies that don't send an email like that, send it more casually. Then I will look at, their social media, how many Twitter followers do they have, how much engagement do they have, who's talking about it. I'll ask the community. I'll do my due diligence before accepting something like that. And also what you said about it being doxed, and also when they message you saying hello friend, hello friend, come on now,
instant turn off, right?
Or your social media handle rather than your actual name. Sometimes.
I'm okay with that because I don't actually say my name very much on my channel.
Oh, okay.
I just say, hi guys, welcome back to FinPact. And sometimes they know my name, but generally I try to keep my identity slightly anonymous.
Now, sometimes they'll put like at FinPact sometimes.
Yeah, they put at FinPact.
Danger.
That one,
yeah. But I don't mind when people say angel, but when they say trading_angel, then I'm like, oh, you just copied and pasted that, didn't you?
Yeah, I think in terms of what I usually look for when a company reaches out, first, like the reputation of the brand and like kind of the awareness that people have of it, but also it's more a case of, do I think that promoting that brand is going to benefit my audience, and is it going to provide them with any value? If I think that it's actually going to be useful to them, like it's a savings app or something like that, that could actually help them with their financial journey in some way, then I'm going to be more likely to actually to be willing to promote it. So it does kind of come down to what you think your audience would benefit from. So I think that's like when I'm like agreeing to a deal, I think that's the main thing that I usually look for.
It's a fine line between looking for what your audience wants, but also what you want to put out. I kind of try to keep it a balance. So sometimes things I put out don't get very many views because even though I think it's important and in fact the most sensible way to go forward, people aren't that interested. And then sometimes I'm not really so keen. So there was one sponsored video I did on a meme coin, but it was a really hyped up meme coin. And actually my audience really wanted to watch that. And even though I was like, it's a meme coin, it is risky, but I'll cover it for you guys because I know you guys want to see it. So I did the due diligence for the video for them. So I think it's keeping a bit of a balance in that sense.
Yeah, absolutely. And I mean, I didn't want to go into it too much, but obviously we have to discuss it a little bit. There's obviously a lot of scammers out there. And I don't know if you guys have had experience with copycat accounts and people trying to use your identity to get money out of other people. Oh, there we go. I'm seeing some faces here. So I mean, for me, this is a daily battle.
Yeah, I get messages on a very regular basis, almost every day. Someone's telling me, this guy pretending to be you is messaging me saying, I can, make you this, invest in this or whatever it may be. And I'm like, yeah, it's tough. It's honestly, it's like, also there's like these TikTok accounts and they like spam my comments and they reply to every single comment. like saying, WhatsApp me on this number to make 10 grand. I'm like, yeah, that's not me.
Yeah.
So
Yeah, do you know what I actually do? I actually go into search on my name at the beginning of every day, and I find the new ones that have been created, and I just block them before they've got a chance to message on my posts. But still, they're still sneaky, aren't they? They manage to get in there.
I don't know how they manage it. Yeah.
They're relentless, but it's a full-time job getting rid of them all. So what would you say to someone? Oh, sorry, Karen.
I was just going to say, I think the worst that I've experienced was, the comments are bad, but the worst was someone I think they still have that, replicated my Telegram account, which is what I primarily use to respond to Patreons and sponsors and friends on YouTube. And they started messaging sponsors, accepting deals, taking money from the sponsors. And the sponsor emailed me saying, "You've not done this video." I was like, what?
Wow.
Yeah. So they must have paid some random person who forged my name. But it says very clearly in your description box the exact, email or Telegram name. So that's dangerous for also companies.
I think the problem is it's such a new issue. 5 years ago, we weren't even thinking about TikTok copycat scammers. This is just such a new thing. And I think people are still finding their feet with knowing how to trust people and who to trust. So, I mean, I think it'd be really helpful if maybe we work out, how do we know if it's a legitimate account? What are the telltale signs? What should people be thinking about? What should people be looking for? Who would like to go first?
Yeah, I think for a legitimate account, look at the followers, look at the content, look at the engagement, look at the likes, look at the comments and stuff. Those are hard to be faked, especially from other reputable people commenting on such posts. I'd say look at that, and just feel free to scroll down and make sure, scroll down on the history and see when the photos are uploaded, because I've noticed with some copycat accounts, they'll do it all in one day. So they'll copy all my posts and upload it all in one day. So you can just tell, oh, that's not. Whereas my own page has longevity. And think about it, not being rude, but it's unlikely I'll DM you out the blue to ask for your money. If anything, you're DMing me. So you just have that common sense of, would Poku really DM you out? So yeah, it's just little things like that. But to fix it, I feel like Instagram and TikTok, they need to start verifying accounts, man.
Yeah, that's exactly what I was gonna say. TikTok specifically, I think, really needs to do that.
Because it's not out of the blue for a financial creator to talk about money to you, because it's like, to them, they see it as like, oh, I'm really gonna get put on now. This might be my big break. Oh, I'm gonna start working with Poku. So for them, it's like, since I talk about money, they'll take it in. They'll feel like it's an opportunity to them. Their lives change. Whereas like if a fashion influencer messages you about money, that's easy to say, oh, that's a scam. Why would they? So from both sides, it's hard. But yeah, just take your time before sending any money, and watch the language as well.
I think there's something easier than anything. It's just simply click on their description box or their profile page and see exactly what email and what username they've given. That's it. Anything else is a scam.
Yeah, I think asking for money or any sort of personal information has to be the immediate red flags to say that it's not legit for me.
Yeah. And what platforms do we think are the best for finding investment advice on, or financial advice on? Do you think there's one that's better than another, or one that's particularly bad or particularly good? Any thoughts there?
XTB.
Yeah. Social media platform. I think TikTok, to be honest, that's my personal view, but that's just from my experience. And I think that, I think there's really, really good content, really strong content on TikTok. But I don't know what you guys think.
I think there's strong content on all platforms, but then there's also bad actors on all platforms as well. Just knowing how to, because actually, to be fair, I feel like with TikTok, in my opinion, I think that could be the worst.
Same.
At times, actually.
I was going to say that.
At times, but I think that's great, but you just need to know how to easily diverse and pick who to listen to and who not to, because there's certain crowds. But when people can just go viral with little clips and
Also with TikTok, it's the thing about TikTok is, of course, there are great creators and everything, but you have to grab the viewer straight away, right? And it has to be certain duration of time. I think sometimes it can be trickier to judge who's telling the truth and who's actually got credible analysis, let's say, than, I mean, obviously I'm a little bit biased towards YouTube, but the one thing about YouTube is that your videos can be 12 minutes long. You can have charts, you can show. So if you're, talking rubbish, then it can be spotted throughout the video. Oh, they've not done this. They've not given any fundamental analysis and no technicals, that sort of thing.
Yeah.
I feel like with me, I've learned the most on my journey through YouTube. Like the YouTube kind of content that I watch is somebody who posts like hour-long videos, because you can really kind of break it down and digest it, and you get all of the information out of it that you really need to. Whereas, like, you said, Annika, it's so tough to do that in a short TikTok video. And because of the nature of having to grab the attention of the user so quickly, it creates that incentive to kind of manipulate and almost kind of falsify and make it a bit more flashy and a bit more fake than it really is. Exactly. In order to kind of get the views and gain the traction that you might want. Because especially with TikTok at the moment, since it's been booming, it's so easy to just blow up overnight. Like that's what pretty much what happened to me on my first video. It got like 200,000 views in like a day, and that was when I realized, wow, the power of this social media platform. So when you can really blow up so in such a short period of time, it really does create that incentive to try and maybe be less truthful and more engaging than you should be.
But Tim, you mentioned about TikTok. I think maybe all of us might think this, but I think they complement each other. You can see it. You could be a nouveau investor or just someone interested in finance, see a cool TikTok about a project or a savings method, and then you can shift to YouTube and find a more in-depth video. So I think it goes hand in hand. It depends on how much research you do based on both.
Absolutely, yeah. It is ultimately it is down to kind of the user, whoever's watching, to kind of take the right steps, like you say, to gain more information before blindly following. But they definitely can complement each other.
What do we think in terms of the future of investing? How do we think that the landscape of investing has changed now that we have these social media platforms to talk about it on? What do we think this holds for the future?
I feel like it'll become a big minefield in a sense, because there's so many opportunities being flung around. There's NFTs, there's lots of cryptos to invest into. There's so many investment vehicles, and I feel like the younger generation, they're just gonna flock to where the hype is. So I think for the future of investing, I feel like investors need to be more diligent and actually analyze whether this is right for me. Does it suit my investing style? Me personally, I like liquidity. So NFTs isn't really appealing to me. It's only worth what someone's willing to buy it for. It's not. Whereas with crypto, there's liquidity on the exchanges. I can sell at the tap of a button. So I feel like a lot of people just want to chase the next biggest thing, and especially with the new social medias, it's easy to get word across the internet. So I feel like you just need to analyze certain opportunities and think, does this truly fit with my investing style, or am I just chasing the hype?
Yeah, absolutely. So we're coming towards the end of the session. And as I said, I wanted to try and come up with an acronym. So what do you think about this? We've got TRADE. T, testimonials. Is a person backed up? R, realistic. Is what they're proposing, is what they're offering realistic? A, accreditation. Where did they learn about finance? Are they,
Yes,
D, due diligence. Have you done your due diligence to check out who they are? And E, educate. Educate yourself about the telltale signs. How's that work out?
Sounds good.
Yeah. Okay. Well, thank you so much, everyone, for joining me today. You've added a lot of value, and hopefully people feel a lot clearer on the telltale signs and also how to stay safe when learning about trading using social media. Thank you so much. Enjoy the rest of your weekend.
Thank you so much.
Thank you, Caroline.
I hope you enjoyed.
So thank you so much to the TikTok Roundtable. Now I'm so excited to be introducing our next guest. He is the man who started a community which changed the rules of Wall Street. In 2019, WallStreetBets passed over 800,000 subscribers and had more than 3 million monthly unique visitors. Jaime Rogozinski is the founder, and he is joining us today from Mexico City. Welcome, Jaime.
I just pulled the Zoom. Thank you very much. I'm so happy to be here.
Thank you. Thank you.
Yeah, I really was enjoying that little roundtable, especially with a lot of these changes that are taking place in the world of trading, especially when it comes to the instruments, right? This concept of NFTs, the concept of crypto stuff, the concept of, I don't know, risk. But one of the things that I've learned throughout the years is that there's this common denominator for anything finance related, right? Like people that want to get involved with excuse me, trading or investing. There are some commonalities that you're able to transcend even at the stuff that doesn't yet exist, right? Like such as NFTs. I heard the last speaker was talking about liquidity, right? And how his personal style requires there to be liquidity. That's like a very technical term, right? And that's because his style really does transcend into NFTs, and it turns out that it's not compatible. But if there was to be liquidity, he might actually like to do it, right? So anyways.
Well, thank you so much. We look forward to hearing about your journey today. And thank you for joining us all the way from Mexico City. And thank you for getting up early to join us as well. I'm sure there's a bit of a time difference.
It's not a problem. Actually, I just came back from Europe. So my jet lag still has me in that time zone, so it's not too bad.
Right. Well, if I could ask you a couple questions, I mean, if you could go back in time, obviously you had quite a journey with WallStreetBets.
Yep.
So if you could go back in time, would you do anything differently?
No, to be honest with you, I can't say that I would. Obviously, there's been a lot of trials and tribulations and a lot of great moments and a lot of painful moments. But all of those have come together to give me the knowledge and the experiences to put me in the position that I'm in today. So I can't really say. I think that if you'd asked me that question maybe a year or two ago, I might have said yes. But up until now, things happen for a reason, and the experience that I've learned and the humbling, the fun that I've had, the people that I've met, it's been unbelievable.
Oh, wonderful. Well, we look forward to hearing your presentation. Take it away.
Thank you so much. So I wanted to come here and talk about trading, right? There's a lot of people that are coming into these markets because the trends have been being set for several years. In fact, I wrote a book in 2019 in which I was plotting the number of users that were subscribed to WallStreetBets, which I'll get into in a second, along the side with the number of people that had Robinhood accounts, right? This is in the US where it's just a free broker that allows people to have stocks. And there was already an exponential growth before the pandemic hit. And then once the pandemic hit and everybody's locked down, a lot of people end up staying at home, looking for sources of income, looking for sources of entertainment, especially after all the entertainment was knocked out. And there was this massive spike in interest in retail trading in general, right? This is stocks, this is crypto, this is NFTs, this is just anything that has a number associated to it. And anyway, so there's been a lot of people that come into this and they want to say, hey, what are your tips for investing? You know, it seems like you've been doing this for a while. What's the best approach? And I wanted to come and share over 10 years of experience with regards to what it's like to go through this trading journey in a way that you won't be able to find anywhere else. The reason why I say this is if you start looking for books, if you start looking for YouTube videos, if you start asking people, you'll oftentimes get very similar answers. For example, if you say, well, I would love to put my money into the market so that I can have more of it later on. The question, and then you ask a seasoned veteran and you ask them, what should I do? The first question that anyone's going to ask you is, well, what are your goals? What's your time horizon? What's your risk tolerance, right? Like, how old are you? And and it's a really boring question. And surprisingly, it's an important one. And the reason why is, well, we'll get into the reason why, but that's always where it starts. And if you start reading a book about investing and you want to go towards a conservative side, you're always going to get this whole diversification, and you're going to have different ways to explain the exact same thing. And so there's basically, long story short, there's a lot of resources out there that repeat the same thing. And I wanted to come here and share something that I've never found out there, something that I've basically the learning that I've been able to do through my experience. So let me see if I can switch my slide here and talk a little bit about let me talk a little bit about me. So my name is Jaime Rogozinski. I created WallStreetBets. This is in 2012. For people that don't know, WallStreetBets is an online trading / gambling community. It's now massive. It's now, I believe, close to 11 million people if you go to the subreddit, but there's already communities that are well outside of that, right? But the essence of WallStreetBets is people that are hungry for risk, that are hungry for taking an approach to the market in a different way that it's currently being used for, right? As far as I'm concerned, there's two types of camps for approaching the market. The one camp is, let's do investing. Let's put money towards my retirement account. Let's diversify. I don't care if I make 6% a year for the next 20 years. It's going to do compound, it's going to be compound returns, and I'm going to get dividends and blah, blah, blah. It's basically long-term, low risk. And then you have the shorter term ones. These are professionals. These are traders that do this for a craft. This is the one, this is the profession a lot of people hope and fantasize about, which is, hey, you get to sit at home and you get to click buttons on your computer and you get to make millions, and it's great because you don't have a boss, etc. Turns out that particular profession is a difficult one. Like over 90% of the people that try to do that fail. And there's a lot of reasons for that. And the people that succeed do this for a profession. They have, like, it's a craft, right? They wake up, they have a routine, they have their trading log, they do whatever it is that they do in the morning. They have this discipline and they sit in front of the computer, or maybe they don't, or whatever it might be. But it's definitely not this fantasized version of a profession. So those are kind of the two extremes. WallStreetBets kind of lands in the middle of those two, which is, hey, sorry, and one thing I should have added with regards to the traders that do this full time, they're doing this short term. These are day traders. These are traders that are going in and out of the market, as opposed to investors that are there for 30 years. So WallStreetBets is coming in here and saying, no, look, I have a job, I have other sources of income, but I want to supplement them. And I don't want, I might also already have a 401k plan. I might already have a portfolio for my retirement, but I want to supplement that by having fun, and maybe I'll get lucky and I'll win the lottery, or maybe I'll end up losing the money. But I also want to try and learn and exploit this market and find this, find inefficiencies that cater to me. And that's basically the essence of WallStreetBets. I've traded stocks, I've traded crypto, futures, Forex. I've done day trading, swing trading. I have never created a full-on algo, but I've seen enough people try that I understand the complexities behind it. People that trade, I've traded off of news. I've traded basically a lot of different instruments, a lot of different styles, and I've been able to find my own niche. What I want to talk about today is one that applies to all those styles and all those instruments as well. So the first thing I want to talk about is the journey that people go through. I went through this journey myself, and I've seen every single individual that comes into the market go through these stages. The reason why I want to share this is if you have not started, or if you have started and you're somewhere in this range, I can hopefully save you some headache and hopefully save you some money. One thing is reading books about knowledge, right? So you read, let's suppose that you like technical trading, and you read a book that teaches you about support and resistance, right? These are lines you draw on a chart. that predict to some extent the price action of a particular instrument when it goes and touches one of these lines that you drew. So if you have a support line, the idea is, okay, a price is above it, and if it hits this line, it's going to bounce back up, which just means it's a good buying opportunity. Vice versa, if it's a support, sorry, resistance. If you start trading one of these, if you start trading one of these strategies without, sorry, I just lost my train of thought. Anyway, so I'm going to go through the different stages of it. So the stages of trading is, the first one is clueless, right? This is somebody that comes into this market and says, I want to have fun, right? I heard you can make millions doing this. I heard GameStop went to the moon and people made a lot of money. Or I heard if you're doing NFTs, the Bored Ape Yacht Club, I would have da-da-da. I don't mind losing some money. This is fun, and haha, I'm gonna enjoy this and share some memes. The next stage is luck. There's just this weird philosophy. I don't know if there's any scientific studies that have gone into it, but it's fair to say that the overwhelming majority of people that start trading with this clueless attitude have this lucky win or lucky set of wins when they first get started. And that gave rise to the saying of the first one's always free, right? This is the market's way of trying to lure you in. This is kind of a meme that was born. It's like trying to get a free sample when you're going to the mall, and I don't know if you go through the food court, at least before coronavirus, you'd get a little free sample so that you get tempted to buy their food. That's what the market's doing to try and suck you in. It's true. I don't know why it's true. I'd love for there to be some kind of a study at some point. Then there's this reality check. After you've been tempted, you're like, wow, this was fun. I made money, right? I'm going to start putting more money towards this. I'm going to start dedicating, turns out this is a good thing, all right? And then all of a sudden, people start having problems replicating that early success. After that, you have this moment of desperation, right? Where you start changing different strategies without any rhyme or reason. You're like, hold on a second. It really worked on step number 2, right? It really worked when I got started, and now I'm not making money. Why is it? Okay, maybe it was this, maybe it was that, maybe it was, whatever the factors are that you're starting to modify. And eventually people just start copying other people. Like, you know what, whatever. I'm just going to follow other people that know what they're doing. And I'm hoping that they tell me what to buy because this sucks. And then the end of the road, this is kind of the crossroads. This is the moment that I think is the most important step, which defines whether you're going to be successful in this venture or whether you're not going to be successful. So by the end of the road, I don't mean this game is over. I mean, people pick a direction and tend to go into that direction. That's what I've seen. And by direction, people either give up because this is not for them, or they continue doing this. They continue trading because they figured out something that works for them. So let's dive into each of these stages. And I'll share some anecdotal evidence about me as well as other people that I've seen to go this. So I get started in this because I had lost my job in the 2008 financial crisis, and I was without a job for about 6 months. And, I had savings, but it still sucked because I had to eat out of my savings and that uncertainty and blah, blah, blah. Thankfully, I was single at the time. I didn't have any kids or dependents, and so there was a little bit less stress on my shoulders. But eventually I ended up getting a good paying job. And I said to myself, never again, right? This is not going to happen again. I'm going to, first, I need to resupply my savings account, but also I want to become really, really rich so that I no longer have to deal with this in the future. So I start experimenting. Back in the day, there wasn't any of these free brokers. There were discount brokers. And I start, I was familiar with the stocks. I was familiar with the stock market. I studied economics and computer engineering. And eventually by the time I was doing this, I was working on my master's with WallStreetBets. And Sorry, I just saw a question that was coming in here. So I was working on my master's with WallStreetBets, and I decide I want to supplement my income, and so I knew about the market, and I just didn't have any hands-on experience. I bought a few stocks before, but the stocks, they go up like on a crazy good day, they go up 2% or 3%. So if you have like $1,000 or even $10,000, we're not talking enough money to retire. So I started experimenting. I said, all right, I'm going to put some money aside every month, and I'm going to see what kind of instruments there are. I discovered leverage, right? Leverage is when you take a little bit of money and you're able to control a lot more money. And leverage, you can find it with CFD brokers like XTB. You can find it with instruments like stock options, futures, Forex, crypto. I haven't really explored all the options in leverage with crypto, but I know that there's a bazillion different offers out there. There's some instruments that have toned down leverage, like ETFs, that'll give you a 2x or 3x multiplier. It literally just means if I take $1,000, right, buy something that's going to make it look like as if I had 100,000, or in some cases more. It's really risky, but it's a lot of fun. So I started getting into stock options. That was the first instrument of leverage, and boy, was I having fun with that, because you can literally take $100 and turn it into $100,000. Not very likely, but it can happen. I've seen it happen once. And sure enough, I won. I often say that the best thing that can happen to a trader when they get started is to make money, not to lose money. Sorry, is to lose money, not to make money. Why is that? It's kind of counterproductive. The reason why is because the trader that makes money, that they start with this false sense of how easy the market it is to beat. All right. You don't know. There's oftentimes, what's the Dunning-Kruger effect, right? It's like this idea where you have this kind of a false sense of what your abilities or capabilities are because of your lack of knowledge of the complexities of something, right? Think of, I don't know, what's hard. Like I don't know if you've ever tried to play golf, right? But if you take a line drive, when you get started, you hit the really big stick. You're supposed to hit it, whatever, 200 yards to 300 yards, a tiny little ball, and you're supposed to land it on a grass field directly in front of you, or sometimes directly in front of you. That's like 20 or 30 yards long. Like if you take a beginner and they walk up to that ball and they just whack it without any style, and they happen to land the ball on the fairway, that's maybe the person has potential, but is most likely luck and is most likely unreplicatable. And this person might be able to feel, wow, this is easy. All you need to do is use my muscles and then I'm good to go. Whereas the experienced trader goes, now you got to consider with your hips and with the thing in your eye and with the ball and the way that you're holding the thing and the wind resist that. There's a bazillion different factors involved. So if you make money at first, then you have this false sense of how easy this is. If you lose money, however, you're forced to become humble, where you're like, wow, this sucks. I just lost money. Perhaps I should be more careful with this. More often than not, people make money. So that's what ends up happening. So the person starts their trade, they open their account, they decide to fund it, and they make money. They're like, hooray, I'm going to have a Ferrari soon. All I did was I took $1,000 and now I have $2,000, and it took me 2 days to do this. So that means that if 2 days and blah, 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 and they start multiplying $1,000 times 2 days, all of a sudden they're making $170,000 a year from this, and they can buy whatever they want, and they can retire, and they can go on their yacht, blah, 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 right? And all of a sudden they start to try and replicate, at least I start to try and replicate these things. And I'm like, all right, well, clearly this works because whatever kind of factors. I'm trying to be purposely generic with these examples to see if I can relate to whatever your style or instrument that is that you're doing. But once again, I want to repeat that this works for all instruments and all trading styles. Confirmation bias. This is a bias where you're looking at incorrect factors and attribute them to your either success or failure to what it is that you're doing. For example, I was wearing a black shirt the day that I made money. Therefore, and then today I'm not wearing a black shirt and I'm not making money. Therefore, I'm only going to trade with my black shirt. Right? This is obviously this is a silly example, but if you start using variables that are market related, it's just as silly. For example, if I traded the open, right, 9:30 in the morning, you have a lot of volatility in the stock market, and that volatility tends to wither down by 10 a.m. right? So like after about a half hour, you stop getting volatility. So somebody might say, well, I started trading at 9:35 yesterday and I made money, and today I started trading at 9:37 or 9:40 and I lost money. Therefore, it's the exact time that's relevant. That's just as silly as saying what the shirt is. But it's not completely silly, right? Because in theory, if that same experiment was dragged out to, hey, yesterday I did it at 9:30 and today I did it at 10:30, then that's a valid observation without this individual even knowing why that's a valid. The second thing is the number of variable floods. There's so many factors, so many factors that it's just impossible to keep track of them. How do you know which things to pay attention to? Oh, it's because there's news today. Well, look what's happening with Russia. Oh, it's because I'm going to put on some indicators and some overlays and some moving averages. Oh, you start making so much additional noise. Things are so hard as they are. Putting in more variables and cherry picking the ones to try and attribute that to your early success and or now failure, that it's so easy to pick any variable you want and just retrofit this story. You start losing confidence, or at least I start losing confidence, start becoming impulsive, like, screw this, I don't really care, I'm just gonna trade it, I'm just gonna try whatever I can until I start getting some luck, and then I'm gonna start using those variables to extract. All right, this is where you throw the kitchen sink at this problem. This is this is oftentimes something that I tell people. When you make a trade, someone that has experience with it, they enter this trade and they say, all right, this is my strategy. Let's, once again, technical analysis is easy to use as an example. This is my strategy. I'm going to buy support. I'm going to put my stop loss exactly whatever percentage below, and I'm going to take my target whatever percentage above, right? Because this is my style, and then go, right? And so you push the button, whatever it is. When you're in your correct mindset, that trade goes into your support, you fill your trade, you're watching this thing either go up or down, and you're calm and collected. If you're losing money, you're calm and collected. If you're making money, you're calm and collected. If you're in stage 4, in this desperation stage, you're hoping, you're praying, you're superstition, right? Like at this point, you're looking at the screen, like, God, please, whatever it was that, like that one time that I did the thing, I swear to God, I'm never going to do it again. You're relying on supernatural powers, right? So like, that's how you know you're doing it wrong. The moment that you're, the moment that you're using your lucky whatever, right? You're using your lucky t-shirt. That's what ends up happening. And this is a very valuable stage, right? This stage is important because the way that you react to this particular moment is going to define whether you're going to break out of this loop or whether you're going to stay in this position forever. And what are those two possible scenarios for this to end? You either go back to step 1 or you figure out how to make money. All right. So what does that mean? Go back to step 1 or learn how to make money. Going back to step 1 is what I often joked about with people as the trading purgatory. Somebody says, you know what? I'm going to start fresh. I had so much early success. And by the way, the stronger the success you have when you first get started, the stronger this journey feels. If you made a lot of money during your lucky streak, then you're that much more hooked into this game. So going back to step 1 says, you know what? I'm going to pretend I didn't do anything. I'm going to try to recreate step by step everything that I did in the beginning so that I can have success. And so this might even be starting fresh by using a different instrument or using a different trading strategy or using whatever it might be just to try and clear any biases from this. And sure enough, this person goes, and it's terrible. It's really sad to watch, right? This person will go in there and all the enthusiasm in the world, make money, right? Because you're literally recreating the whole journey. They'll go in there and they'll have their beginner's luck, and so on and so forth. And in the long term, it's just purgatory because like people never break out of this. And then beating the game, that's kind of the goal for people that finally actually break out of this. And I'm going to help you beat the game instead of going back to step one. But it's infinitely important that you understand that this cycle exists, that people do go back to step one, that you have to be aware of where you are in this journey if you're starting, or if you've already started, or if you haven't started. So I'm going to take the next 15 or so minutes to, hold on, let me just see. Yeah. So I'm going to take the next 15 or so minutes to walk you through my cheat sheet, right? So that's great that I've just explained everything to you, and you probably sit there wondering, all right, cool, I can relate to a lot of that, but how do I make money, right? This is a great story. So I'm going to walk you through some of this cheat sheet. The first thing, which is not on here, by the way, is actually do it. Actually get experience. I get asked all the time, what book should I read? All right. I'm like, I read whatever book you want. It's going to help you up here. It's going to help you academically. You're going to know stuff. You're going to know facts. But it's not going to help you trade anything. You can read a book about how to play golf. You can read a book about how to water ski. You can read a book about whatever, and it's not going to help you do any of these activities. You actually have to go out there and do it. And this does not include simulators, by the way, because simulators are just one step closer, right? You learn about the mechanics, you learn about where the button is on the interface, you learn about whatever it is you want to learn about. But it's got the strong emotional components. And I'm going to try not to harp on the emotional component because that's something that, for good reason, everybody talks about. But I do want to emphasize that the emotional component is probably just as important as the knowledge. So what do I say? Go out there and have fun. You get your broker, you fund the account, and you start trading, right? You put a little bit of money in there. You don't want to be reckless with this. You don't want to ruin your financial prospects in life, but put some money in there and actually start trading. What does this do? Why should I just go there without any rhyme or reason? You're going to try and speed up through this journey that I just told you about, right? Like try to get it out of the way. You can't avoid that journey, by the way. I'm not going to teach you how to get straight to step 6 because you can't. You actually have to go through steps 1, 2, 3, 4, 5. So go through them quickly and unpainfully, and hopefully without much frustration. This gives you a feel, yes, for the interface on your broker, yes, for the types of things to pay attention to, yes, for the emotional component associated. What does it feel like when I make money? What does it feel like when I lose money? What does it feel like when I'm under pressure? Because right now there is a lot of volatility, right? If the chairman of the Fed in the U.S. decides to raise interest rates, that's usually cause for the market to do some crazy things. And so then all of a sudden you're having to hurry up and trade accordingly. You want to feel all these different emotions so that you can identify them and you can know that they exist. And you should be able to know that they will affect the way that you execute on all of the book knowledge that you have, on all the reading that you've done. If you're afraid, if you're really excited. So anyway, so go out there and start trading. And that by the way, is also going to define which direction, right? Like, what do I want to trade? NFTs or stocks or futures or CFDs or whatever it is. Start trading it. You find one that you like, one that you can associate with, and then you'll end up reading more resources on that particular microcosm. There is such a huge ocean of information and instruments and styles that it's not even worth trying to learn about all of them, let alone master all of them, right? But it's good to know that they exist. So you go out there, you start trading, something's going to pique your interest. You'll end up reading more about that particular instrument. You'll be a little bit more, I guess you can relate a little bit more to it. In some cases, that's pictures of, apes. And in other cases, these are stocks, or in other cases, these are complex instruments like stock options. And after you've done that, then let's get to work. You go through your first 5 stages, you make money, you get frustrated, you throw the kitchen sink on the wall, you're praying, and all of a sudden you want to move it to the next level. So I'm going to say the first one is keep it simple. Get rid of all the variables. If you look at my chart, when I'm trading, I don't even have a grid line on my chart. I have a candlestick chart with a black background, but without the little dots, right? Without the grid line to help you figure out what the time/price is, because I just want to look at the price. That's all I have. I have nothing on the bottom. Occasionally I'll put volume. Volume is, I think, probably, well, for me, for my style. And I do want to stress that everything that I'm talking about is for me, but it can apply to you. What that does, it allows me to focus on the price action. Now, I am going to say I am a technical trader. That is my strategy. I've tried all the different strategies and I'm familiar with all of them, but technical trading is the one that I have decided to enjoy. On that note, let me just share a story about styles, because you might be tempted to say, "Oh, okay, Jamie's a technical trader and he's able to pull this off. I'm going to copy him." Don't, and I'll tell you why. This is great. When I first get started, I had this chat room with professional traders, and they're all very successful millionaires, whatever it was, and they're all taking different approaches to the market. One was an algo trader, meaning he had like an algorithm that traded the stocks. The second one was a news trader. So he paid like 20 grand a month to have some news feed that would signal his computer breaking news before the actual news gets it. So this includes interest rate decisions for the Fed. This includes economic calendar, things like the non-farm payrolls, etc. So he gets like 8 seconds before the market does to trade on this. And then the third one was a technical trader, much like what I do now. So these guys are all sitting all day long arguing against each other, and I'm learning, and I'm like, all right, so this guy's successful, so whatever he says is true, and he says that the thing's going to go up, and the other guy's successful too, and he says the stock's going to go down. What the hell do I do? So at one point I say, all right, guys, let's figure out who's actually right. Let's take a Wednesday at 2:00 where we know there's going to be news, so that all 3 of them could be included. We're going to have a trading competition. Tell us what you're going to do ahead of time, and then do it. Right. And whoever makes most money makes the most money win. So the technical trader says, well, this is easy. Look, you have a car, and he draws his lines on the chart and he goes, this price is going to go up and down, this, that, and the other. And I'm going to do this, that, and the other. And I'm going to make a lot of money. The news trader goes, well, that's stupid. I know the future. I'm going to know the news before the rest of the world does. So I don't know what I'm going to do. I'm just going to wait until my computer tells me. And then I'm going to act accordingly. And then the algo trader was like, well, I'm not touching my computer. My bot does everything for me, but you guys are both dumb. I'm going to wait until these volatility bands go out and it's going to short and revert it to the mean, blah, blah, blah. So essentially you had, a guy that's doing short, a guy that's going long, and the other guy, I don't know what he was doing. 2:00 comes around and they all execute on their trade, and all 3 of them made money, a lot of it. Right. This means one guy was shorting, the other guy was longing, and I still don't know what the algo guy was doing. And all 3 of them made money. So that's when I realized, holy crap, there is no correct answer. All 3 of them were successful. Right. After this particular date, I asked the news guy, hey, news guy, can you please plug your news algorithm into this chat so that we can all benefit from your knowledge? Right. And this guy was friendly. So he said, sure. But you're not going to make money from it just from being able to know what the solution is. Like, oh, I promise you I will. It can't be that hard. Sure enough, I didn't make money. He plugs it in. I forget the exact story. But the moment that the news flashes across the screen, it's like, oh, crap. Okay, the non-farm payrolls are 3%. Is that good? Is that bad? Am I supposed to buy? Is I supposed to? By then, it's too late. The market's doing crazy stuff. It didn't work for me, right? And why is that? Because I didn't have confidence in my style. I was panicking. It wasn't practiced, etc. What's important to learn about this story, it wasn't whether on this particular day of the competition, whether the right answer was the stocks are going to go up or the stocks were going down. The right answer was, how am I going to execute my trade based off of certain sets of conditions, right? And if I, as an outsider, try to copy one of them, I'm not going to succeed. So I just shared that entire story to hopefully enlighten you in the sense that there's different styles, but also to put a huge caveat in that my particular style works for me. And you might be able to make it work for you, but I'm going to encourage you to do whatever you end up actually feeling confident with, because that emotional component is important. So I don't put anything on my screen. I like to just look at the price. You don't necessarily have to do that, but what I can encourage you to not do for people that don't trade like I do is don't fill the screen with stuff, right? Like you see all these memes of charts that are just drawn beyond belief. If you start putting stochastics and you start putting moving averages and you start putting the RSI and you start putting all these, Bollinger Bands, and you put whatever it is, like there's a gazillion overlays and indicators. That is such a noisy flood of information. Some indicators are going to retroactively prove to have been useful, and the other ones will have not. And so when you're trying to use this information for a future trade, it's going to drown you, right? So I would say keep it simple. You should be able to pick one or two of these things relative to your style and just put that there. If your style doesn't deal with technicals, then don't put any technicals on there. Don't look for additional confirmation, right? If you're a meme trader, meaning like I'm going to wait until a lot of people talk about this stock and then I'm going to buy it, but I'm going to put in these like moving averages just to try and confirm, right? As an additional check. Don't do that, right? You're being noisy. If you want to be a meme trader, just be a meme trader. You can do multiple ones, but only if they relate to each other, such as moving averages, right? So meaning those complement each other. So you want to have moving averages. You're allowed to have 2 or 3 or whatever, right? For the different time frames, because those complement each other, but don't mix and match them. Position sizing. This is huge. What's the right size for the position? Go read all the books you want about risk management. I'm not going to talk about that. That is important, but that, YouTube videos, whatever. Follow other people's advice. It's been repeated over and over. But what I've never seen repeated is the actual sweet spot for the position size. What is a sweet spot outside of risk management? It's the sweet emotional spot. If your position is so small that you don't care if you win or lose, then you won't learn anything. So this varies based off of people's tolerance for losing money and or how much money they have, right? But if you, if you're well-to-do, if you're moderately rich and you make a trade that's worth like $1, then you're really not invested into that trade. You might as well be using a simulator because you're not going to get that emotional component. That's going to prevent you from learning. Likewise, if you make the trade too big, you're going to have that same, well, it's not the same effect, but the same result, that you're not going to learn, right? There's so much money on the line. You're not able to focus on what's going on. You're just really hoping that you make money. You're stressing out, or you're super excited, or whatever it is. But the only thing you're not doing at that point is learning. So find just the right size trade so that you're nervous about losing money, so that you're excited about making money, but also so that you're able to focus and actually gain knowledge as your trade goes through. That's something that I've never heard anybody talk about. Anytime I've ever seen anything about position sizing is always relative to risk management. Once again, you're able to do both, right? Risk management is important, obviously. Don't force it, right? This is another one. Once you have your trading strategy, one thing that I oftentimes see, let's say that your trading strategy deals with, I don't know, let's do a silly one like news, right? So if you've seen 3 headline articles on a stock, you're going to buy it. Please don't do that strategy, but let's suppose that that's your strategy. You end up doing that every day, and maybe you're successful sometimes, maybe you're not, so you're tweaking your approach, but all of a sudden 3 days go past and you haven't seen a single stock with 3 headlines on it, so you've not been able to make a trade. You start looking for it, you start changing your own rules, you start feeling unproductive, and you force it. So then you start making trades where you see headlines with stocks with 2 headlines, right? You start kind of giving into it just because you're not feeling productive. Don't do that, because you're muddying the waters, and in a sense, you're actually adding more variables to your strategy. the best thing that you can do is, if you have a strategy that you have confidence in, that you believe in, just be patient with it. And I can relate to that feeling of unproductivity, because once you say to yourself, all right, cool, I've figured out a way to make money, I'm actually relatively successful with this, I'm actually going to start doing this seriously. I sit down in front of my computer, right? And like I said, I'm a technical trader. So I start looking for these technical setups, and I'm staring, I'm going through the charts, whatever. And 3 hours gone past. I'm like, damn it, I haven't not made any money today. This sucks. So I'm going to bend my own rules, right? Or I'm going to, or next time that I have a trade that comes in, I'm going to position size it harder, right? Like I'm going to put more money into the next trade, or else I'm never going to be able to catch up, because now it's been a whole day and I haven't even opened a trade, right? Like psychologically considered not making money. By doing that, you end up hurting your strategy and you end up losing money. There is nothing wrong with not trading. Nothing wrong at all. If you have a strategy that enables you to trade every 3 days, then just do that and do that. Or if it's every 3 minutes, that's fine too, but don't force it. Timeout. This is the biggest one. Everyone says after you take a big loss, you should walk away. All right. This is somewhat self-explanatory. If you play poker, it's called going on tilt. It's like, screw this, and people start being reckless. You start doing unpredictable behavior. I've never heard anybody say to take a timeout after a big win. And that is hugely important, because they're different sets of emotions, but the impact of those emotions is the same. It's happened to me on more than one occasion where I make a lot more money than I was expecting to. And this happens with leveraged trades. And I was like, holy cow, I cannot believe, now I can buy a new car with this. I can do blah, blah, blah. And I start fantasizing, and I have so much money in my trading account that I can afford to actually take the trades that I wish that I could afford to take, right? These are ones that are very risky, that I was saying, well, if I had more money, maybe I'd throw some money at that one, but I'm not going to. But look at this. I have a lot of money now, right? What's $1,000 here and $1,000 there? And then, because this is the house's money, it's not even my money. And you start trading like crazy, and you give that money all back. And then as soon as you start giving that money back, you start going into that tilt position where you're like, I need to get back to where it was, right? And so it's bad. So if you take a huge win, please take a walk away. Don't sit there and think about how much money you left on the table. Don't. It's a silly mindset. You made money. Call it a day, whatever that timeout is, if it's a day or an hour or whatever it is. And then finally, just remember that the stocks or financial markets, it's a combination between skill and luck. There's no sure thing anywhere. It's much like poker. It's much like these other games that rely somewhat on chance and somewhat on skill. That's what this is. There's no 100% of the times when it comes to trading, right? There's just the majority percent of the time. And that's the world that you're playing in. So if you have a setup, be aware that it fails sometimes, because there's so many factors that are going into it. But what ends up actually paying off in the end is this kind of consistent, methodical way of trading. So with that, I believe is the end. So I'm going to open it up for the next 20 or so minutes for questions.
Thank you so much for that, Jaime. That was really informative. I especially, the thing that resonated with me was beginner's luck. Because I remember thinking I was the best person in the world because I won some money and I had no idea what I was doing. And yeah, you hit the nail on the head there. With how it's a dangerous game. Yeah. And almost the best thing for a trader is to actually lose at the beginning and realize it's not that easy.
Yep. Now and it's sad, right? Because but I went through it, so I'm not fully sad. All right, like this is easy, and I swear you start daydreaming, right? You start daydreaming, you multiply, like, all right, there's 252 trading days a year, and according to this thing, if I could just do that, then boom, I can quit my job. And then some people actually act on that. That's the worst. That's sad when I see people actually quit their job after like a particularly long winning streak.
I did the exact same thing. I wrote out, I was like, right, if I have £100, how long until I make it this? And then now I laugh at myself for being so stupid. But it's funny to hear that everyone else goes through the same thought process as well.
Yeah.
So are you good to answer some questions now? We've got loads of questions coming in.
Awesome. Show me the questions or read them out to me because I'm not sure.
So the first one we've got for you is, how and why did you start WallStreetBets?
So I start WallStreetBets. I got a little bit into that mindset, right? I'd lost my job, and then I'd got a very well-paying job. So I was very comfortable at the moment. I had no dependents, so I could afford to take risk. But I had this fresh in my mind of saying that really sucked not having a job. It really sucked eating into my savings account. I don't want that to happen again. There's a lot of animosity towards Wall Street. At the moment, there was the Occupy Wall Street movement around the world. And I said, I'm not even going to try and complain about Wall Street because they're just making money. I'm going to join them, right? If they're able to use this like a casino, then so should I. And I'm not going to quit my job because this one's a good job and it pays me really well. And it's going to bankroll my ability to do this particular activity. So that was kind of that's kind of the why. And I wanted to share. I wanted to find other people that were like-minded, and I wanted to find people that were not more knowledgeable than me. I wanted to share it, and I wanted to find other people that were in my position that wanted to learn. And I created it. I started a Twitter and a YouTube and a Reddit, and I forget which other places. And the one on Reddit was the one that ended up kind of growing organically pretty fast. Nowadays, you have WallStreetBets everywhere. You have it on Reddit, off of Reddit. You have Telegram, Discord, this, that, the other. You have a lot of subsets of WallStreetBets, like geographic ones, Korea Street Bets, India Street Bets. Sorry. And then you have like instrument-based ones, like Silver Street Bets or Satoshi Street Bets. People have taken the Street Bets mindset and tried to customize it to their own. So it's really more of a mindset now.
Yeah, absolutely. And we've got a question about the Russia-Ukraine conflict. So how do you expect the stock market to change with the current Russia-Ukraine conflict?
That's a great question. So here's what I'm going to say about what I can expect that's going to happen to the stock market. And then I'm going to address the Russia-Ukraine portion of it. And I'm separating them for a reason. Volatility, like if you live in a place that has earthquake, I live in Mexico City, we have earthquakes. You have a big earthquake, you get aftershocks. This is if you throw a bowling ball into a swimming pool that's like got still water, it's going to make these big waves, and it's going to take a while for it to calm down again, right? Think of that example that I just said as volatility. These waves in the water are volatility. Once you introduce a shock into the market and you create big waves, you're going to have big waves until things return to normal, period. Independent of Russia, Ukraine, independent of anything you want. So the moment that you start seeing volatility in the market, just know that there's going to be volatility. You cannot have a 5% day on the stock market without having another 4% day on the stock market, right? Like, just remember these words because they're actually more profound than you probably realize, depending on your knowledge base. You saw this in 2020. You saw that, like, I've seen this over and over again. You introduce shakes into the market, you're going to have shakes. So don't get too hooked on the news. And now I'm going to introduce Russia, Ukraine. What happens when you have a shock in the market? Let's say, Russia did invade Ukraine. That causes uncertainty, right? That causes the volatility. That causes oil to go up by a lot, etc. That volatility that you see on that first day is 100% directly attributable to that particular action. The subsequent days is not necessarily the case. The subsequent days are aftershocks, right? And so the headlines that you see are almost like frustratingly comical, which is, the stocks went down and oil went up, and now oil went back down and the stocks are going back up. And the moment that you start seeing stocks go back up, you see headlines like, oh, Russia and Ukraine had their 7th consecutive talk on peace, right? And that's why stocks are going up today. And I'm like, no, that's their 7th consecutive talk. Why didn't the 6th one or the 5th one do anything, right? Like, this is basically news organizations trying to attribute stuff to stuff. Don't fall for that. The first invasion made the markets go crazy. Most subsequent headlines are not related to the stock market. It's just uncertainty. This is price discovery. This is big players trying to reposition themselves. And the headlines are indifferent. So with that said, what do I expect from this particular conflict? Volatility, right? Like, I'm expecting this big shock. Who knows how things play out? This particular event appears to be slightly different than the other ones. I've seen a million doom and glooms. Let's not forget that this is the second time that Russia gets involved with Ukraine. Granted, this is different, right? But in 2014, they got in there as well. And a lot of the language around that conflict was similar to this one. We've seen talks about China defaulting with Evergrande or this, that, like there's all these big systemic shocks. And oftentimes it doesn't really play out. But we shall see. Expect volatility. Expect the big headlines to actually be the market influencers, such as Russia invades. Or I would imagine if China gets involved officially, that would be a big thing. I would not expect hey, they've reached a peace deal to have the opposite effect, because a peace deal, that's going to take a lot. It takes a lot longer to digest ending a conflict than it does to start a conflict.
And I know you touched on this in your presentation, but what would you say makes a winning trading strategy in shorthand? Because I know we've got the long version, but what would you sum up with makes a winning trading strategy?
You have to have confidence in yourself. Like, I've seen silly strategies actually work. And they work because you're in essence, you're capturing that beginner's luck. That's why I'm hoping somebody studies that beginner's luck phenomenon, because there's something to that. All right. And I think one of the things that attributes of beginner luck is you are so confident. You haven't been shaken yet, right? You're seeing things very clearly. You're unaware of the number of you're not overwhelmed by the number of variables that are affecting this particular world that you're in. You're literally looking at a price on a thing, right? And you think it's going to go up because, if it's like you're buying Tesla because you like the car, right? And so I like the car, I'm going to buy the stock, right? That surprising simplicity actually works, because it allows you to focus razor sharp into, I like the company or whatever it is. So have confidence in what you're doing, because if you have confidence, you can actually recreate that beginner's luck, and you can recreate it because you know how to effectively block out all that other noise. And you've got the emotional experience to deal with winning sometimes and losing sometimes. And another thing that I want to talk about trading strategies, be aware that the number of times that you make money on a particular trade does not necessarily dictate the success that you're going to have. The win rate is the statistics. You have people that win 90% or more of their trades, that, they're likely to be successful. All right. Notice that I'm not saying that 90% of trades make money, because there's the position sizing effect. And there are people that only win 10% of their trades, and can also have a money-making strategy. Once again, position sizing. Why is that? Because the guy that's making 90% money is probably skimming. They're probably just taking these really small trades, these really small wins with a really high win rate. So making $1, making $1, making $1, making $1, and then they'll lose $6, right? Like, versus the person that's only winning 1 out of 10 trades, right? Losing $1, losing $1, losing $1, losing $1, boom, I made $100, right? That actually works, and that's sustainable. So don't get too focused on the number of times that you've won. Focus on the bigger picture.
Great. I've got a couple short questions quickly before we wrap this up. So how much time, so this is from Mansur, who sent it through on YouTube, has asked, how much time should a mid-level trader spend daily on trading or studying?
If this is a full-time trader, then treat it like a full-time job. Right? It is a full-time job.
Yeah.
Excuse me. So if you're doing this full time, that you treat it as such. It is a profession. It's not, part of the reason why WallStreetBets actually was successful, this is kind of a fun thing, is because professional traders are bored, right? They're sitting there. It's a craft. They have to actually sit there, and it's like they don't have a boss necessarily, but that screen is their boss. And oftentimes these bored traders are looking for things to do, and they bumped into WallStreetBets. They're like, wow, this is a great way to pass the day as, I'm looking at these charts or whatever it is. And that's because that's what that's like. So if you're doing this full time, do it full time, 40 hours a week or more. It doesn't mean that you have to trade the full 40 hours. It just means you have to keep working on your strategy for 40 hours and monitoring and fine tuning. If you're doing this, if you're doing this part time, then whatever time you're able to afford, because realize that the guys that are doing it full time are dedicating 40 plus hours.
Yeah. So final question, what's next for you?
Oh, I'm having a lot of fun.
More fun.
Nah, look, it's clear. It's clear that there is a lot of interest. It was clear before the pandemic that there was a lot of retail growth in the stock market, and it became more clear after the pandemic. And then we had what happened with GameStop last year that ended up even drawing more attention into this particular subject. But the world of actual Wall Street bets, as people know it, like it's slightly too advanced for the beginners. If you don't know anything about stocks and you go to Wall Street Bets, it's gonna go over your head. It's not beginner friendly, and that leaves a lot of people looking for information, and they're looking for information in a way that they can digest it, because it's boring to read the same thing, or risk management and what the thing, like, when somebody, now that I know as much as I know, when people I know walk up and ask me, hey, what do you think I should do with the market? As hard as it is for me to not answer this, I actually give them the stupid financial planner question, which is, well, what are your goals and what's your risk tolerance? Because it's like, unfortunately, it's true, right? You need to actually ask these questions. And so anyone that is in a position to be able to share information is going to share the same information, which is why you see it over and over. But I believe that there was a different approach for the market, which does not have to start with what are your goals. It does not have to start with these kind of a boring, well, let me explain to you, the risk management strategy is the expected value. But, you can do that, but there's also memes. Memes also do a great job at explaining stuff. They're profound and they're funny and they're entertaining. So I'm starting I'm working on being able to have information that's just, channels that are more attractive to people that are slightly below the ability to understand Wall Street Bets, that are more beginners, but they just want to have fun and be entertained.
Excellent. Thank you so much, Jaime. It's been such a pleasure to talk to you today. Thank you so much for joining us.
Thank you so much. This was great.
Thank you. Enjoy the rest of your weekend.
You too. Bye-bye.
Bye. So just a quick reminder that all the speeches will be available on the XTB platform, and the speakers have also prepared exclusive bonus content, which is available to all XTB account holders. So please don't hesitate to get in touch with an XTB to learn more about this offer. We are going to have a quick 5-minute break now before our final speaker, who's going to be Patrick Reid, and he's going to be talking about why inflation is so important in trading.
Successful manager, smart investor, nice guy. Who do you want to be? You want to have the knowledge and intuition that always gives you the advantage. Do you want to have at your fingertips access to the latest technology that lets you be one step or even a few steps ahead? To have stories of all of your victories and defeats, but always take lessons on how to improve. To feel the emotions, the excitement, because in the end, you see your strategy is working. Do you want to be like me? You can when you trade with XTB.
Welcome back to the XTB Masterclass. I'm so pleased to announce our final guest of the day. Patrick Reid has over 15 years of experience in trading futures and spot forex. Along with being a visiting lecturer at the University of Cambridge, he's also co-founder of financial consultancy, the Adamas Principle. Welcome, Patrick. It's so good to have you here today.
Hi. Well,
Hi, how are you doing?
How are you? How's it going?
I'm really good, thanks. I'm really good, thanks. It's been a great day of education. How's things with
Yeah,
you?
I caught a bit of the Jaime. It's fantastic, really fascinating, and he really blew the lid off retail trading, and it's great. I mean, it looked fantastic. I'm super excited, and I've got some good insights for all levels really today.
Oh, amazing. I can't wait to listen to what you have to say. So take it away.
That's fantastic. Yeah. Well, I just thought I'd say hi. I'm Patrick, the Adamas Principle. This is my deck. This is our company, and I would just like to say I just want to get my trade. Let me see how I can get my screen up. Here we go. Yes. So can everyone see the two people here, Adam and myself? Is that possible? Let me just see. I can't see both screens actually. Yep. Okay, great. That's fantastic. Got it. Okay. Right. I'll get there eventually. Apologies. So really, thanks very much for a great intro, Caroline. And I want to just introduce who I am, where I came from, because I think I have a kind of a unique journey. And my heart goes out to any retail trader, because I used to be one. And, late in my life, I really, well, not late in my life, I've still got a few years ahead of me, but in my late 30s, so not young, I basically I saw Wall Street, I loved it. I just thought, this is for me. And I really wanted to be a trader, like an institutional trader. But I thought, I hadn't got a university. I wasn't particularly good at maths. I really had this idea that, you had to do an MBA, you had to, go through the ranks to be a bank trader or whatever. And I never realized that there were different types of traders on the institutional side. So I met a girl whose husband was a big prop desk trader. He owned a company, one of the biggest, if not the biggest in the world, tower trading. And they were trading futures contracts. So I basically, I was like, yeah, let's go out for dinner. And, I went to see them in Tower 42 on the 3rd floor. And I was like, every single desk had like 12 screens. There was shouting. There was like squawks. There were multiple feeds. There was mayhem. And I was like, I want this. I want a slice of this. So I basically ditched the career at the BBC, became a futures contracts trader. And, I had saved up a bit of money and I started renting a desk, and that was what they call a local. And basically, all the prop desks came straight from Chicago, from the pit, with the multicolored jackets with the hand signals. That was from Chicago. And in London, there was a thing called Life. And when that closed, they moved on screen. And that was really the birthplace for prop. Obviously, banks used to have prop desks before 2008, trading their own money. And I did their apprenticeship at the grand old age of like 39. Kids were around me like 21-year-olds, and I was like, what have I done? I wanted to go back to my cozy BBC job, which was all right money, but I just thought, you know what? I didn't have many commitments, and I just thought, I'm going to go for this. I'm really go for it. And I just thought, now's the time. So I did that for a year. I made not much money in that first year. I endured the pain of waking up really early, getting on the desk for 6:30, getting bombarded with loads of different information, But I got myself a mentor, someone who had been there, done it, and I very luckily sat near a guy who made about 100 million in his best year. His name was Andy. They called his nickname was Braveheart, and I was just like looking to get maybe not that much, but getting a little bit of that, and that was my first kind of realization that this is big. This is like a game changer. This is going to change your life, and then through that year of pain, the first kind of month of the second year, that's when I really made some proper money. I kind of made a whole year in 2 or 3 trades, and that's when it really took off for me. I then, after that, got headhunted by a new hedge fund, and went to trade spot effects, and everything I learned in futures was fantastic. It was direct market access, level 2, I think you call it, with order flows. That was proper institutional trading. That was massive at the time, but when I moved to spot effects, that was really when I realized how small that was. So this is when, doing some proper size, getting really into the nuts and bolts of spot effects. And I then had another mentor who basically sat on big desks on sell side. When I say sell side, I mean banks, not hedge funds. So HSBC, UBS, Goldman Sachs, JP Morgan, all these companies. And I learned how to look at everything. I really did. And I learned that not everyone on the institutional side knows everything. And sometimes with the same information, you can have a completely different view. That's what I learned. And I also learned risk. And I learned that risk management is a good thing. It's creative. It's the best. And how you slice your risk is really equated to having a beautiful organic bonsai tree. How do you prune it? Or a rose bush? You cut too much off, you'll kill it. If you let it outgrow, you'll kill it. So that's really risk management, and that is like managing your trade. It's like knowing your sizing. I think Jaime was talking about size. It's knowing how many trades you've got in you. It's knowing how to, upscale, downscale, a bit like a ruler, So then that really blew off. And then about 5 years ago, my old boss, Adam, who's the guy here, this is my old boss. So if I can use that, here we go, look, that's Adam. We formed Adamus Principle, right? So we thought, you know what, there's a real lack of education out there at institutional level. So I head up the education arm. We're both co-founders. And that's how we really started. And Adam really looked after some of the business development and also the consultancy. About a year and a bit ago, we started a recruitment arm, and it was really word of mouth. So those are the 3 verticals we have. We're based down in Bishopsgate. We globally travel, and we are world market experts. We've got it's just Adam and myself. It's a small company, but we primarily look at FX, but we also look at fixed income and equities. And we've got a host of trusted associates who really, they range from having, been in hedge funds, they've sat in big seats on sell side in big banks, they're strategists, but all of them have, some of them have PhDs, right? So they all have certain particular strengths, and these are those strengths: FX, macro experts, they're money market expert, interest rates. I quite like interest rates myself. We have central bank contacts. I have a kind of a person I go and see at the Bank of England who trades there, and part of trading in a central bank is looking at what the market's thinking and feeling. So part of his research and development is to talk to participants like myself that go there, and I remember the first time I went into the Bank of England, it's just the most beautiful, amazing place in the entire world. There's like frescoes and like Caravaggios everywhere. It's just marble staircases and all that. And it's actually got a bank within the bank. Probably not for this session, but it is an amazing place. But the great thing about it is, as a trader, I'm just curious. As a trader, I wasn't born into it. I became a trader late in my life, and flourished. So if you're thinking about doing it, just ask questions. You can ask me anything you want. This is where we've worked, right? So some of the big shots you can see. Tower Trading is here with my marker. But yeah, so you can see this is where we work. JP Morgan, Goldman's, UBS, some of the big banks there. I've been in the news, right? So last week I was on Daily Mail. I've been on BBC. I've just done a various amount of shows, and this is really all because of interest rate hikes in the UK. It's the Russia-Ukraine. I've been on talk radio as well, but also I've been in one of the things that I was interviewed by the Telegraph. I trade my book, obviously, but I also have a portfolio. And if you're able to put some aside for a long-term plan, my portfolio, I've transferred 20% of that into the digital environment. So that was the interview about that. I'm a regular on Reuters Global Market Forum, and then some of the tabloids have interviewed me as well. And also I have the Russia-Ukraine war. The Express have been in touch a few times. So I feel that this is like something, I do love. I love doing it. And I think that it's really important, if you don't quite understand what is going on, to just really open your mind to ask questions, and things like that. These are our partners, right? Incredibly, and I have to pinch myself, actually. I'm a University of Cambridge visiting lecturer, macroeconomics. So that is incredible. And this kind of came about when I did some interviews as a trader to some of their undergrads, and we just got on really well, and I really connected with the academics there, and I've been up a few times, and then they just offered me this position. So I was like, yeah, this is fantastic. They are very clever people, though, so I have to be really on my toes. But Alpha Bank is a Russian bank. It's the second biggest Russian bank in the private sector, and they are our partners. But I'm not really going to go into too much about that, but they are still our partners. But also Beerban Pro, they're from Switzerland, and Elfin as well, just some of our partners. So today we're going to get down to it. What are the three main things you're going to learn in this masterclass? I think there's a lot I'm going to go through, and if you don't understand it, don't worry. If you ask me anything you want, and I'll do my best to explain it. But I think the key thing before I want to go through these 3 points is I want to create more questions, because obviously I want to explain the different types of inflation, and also why that's important for everyone, from central banks to traders to the economy, for general people on the street. How the cost of living will affect you, and really it's so important. It's super important, and it really, for me, was a massive thing. From last year, this whole idea, I don't know if you're aware, but many central banks, particularly the FOMC, told us that inflation was transitory. It was here, but it's going to go to, it's here today, gone tomorrow, kind of thing. They were clearly wrong, and now it's even higher. So how to trade it, what you do in that scenario, and really understand the dynamics of inflation. And I've got an important interview in the UK, because I'm based in the UK. I've got a great interview with meeting with the ONS, the Office of National Statistics, one of the statisticians there, and an economist there. And you know what? Somebody asked me how I get these interviews. I called them up. It's really, anyone can do it, you know. And I'm like, this, you know, they release inflation in the UK, and you know, there's a hot topic at the moment. I've got a bit of a bugbear about stagflation, which I'll come to in the presentation. And I've got a bit of a bugbear about how the government's portraying the UK economy. So I'm going to call them up. I've got this meeting on Monday, right? And I just call them up. So call people up, you know, link up with them, say on LinkedIn or whatever social media you're part of. Email them, just badger them. You know what? Half of these people, they actually want to help. You know, they're especially the academics and the people. They actually, because you know, they just. I mean, some of them don't, but just call them. I mean, that's how I learned how to trade. It's just badger people. You know, people with a lot of experience. So, okay. Look, without further ado, the 3 things you will learn from this masterclass. 1, why is inflation at the very heart of a central bank's thinking? Okay, it's very important. Why is the central bank important? Because they set monetary policy. And when they move, markets move quick. And if you know or can anticipate that, you're going to make a lot of money, right? 2, you will understand what a central bank does. What is their mandate? You know, sometimes you hear about this thing called a dual mandate or a single mandate. So I'm going to talk a bit about that. And then the final thing is you will be confident to discuss all types of inflation. That's, I'm pretty confident you will be, even though you may be doubting. So I'm going to do my best. Okay, right. Okay, so what I'm going to do really is focus on US inflation, because there's loads of different types, and I just want to give you a little bit of background on what it is, and some of the flaws it has, but it is the common metric, right? So you just have to kind of bear in mind, it's a bit like you know, you have a wayward uncle at a wedding who's super embarrassing and old-fashioned or whatever it is. You love him to bits, and he's all you've got, right? So that's a bit like inflation, right? It's got a lot of problems. It really has. But in the US, the Bureau of Labor Statistics, the BLS, and basically it's a basket of goods. In the old days, you used to put a pint of milk, a loaf of bread, a newspaper, whatever, and that basket, they average it out, come up with a number, a percent, an index, or a mean average. That's your cost of living. Now, in reality, that basket is like many hundreds of things. It's actually, I think, 1,000 odd things in the US, and it's constantly changing, but it's very slow. It's lagging, right? So it is got. It's the metric that people look at, especially central banks, and there's not CPI is, you know, the headline and the core. That in particular is not really looked at that closely by the US FOMC, the central bank in the US. PCE is, and we'll come to that in a sec. As you can see, there is a lag. Basically, every so often, there is a lot of the experienced people within BLS will look at it and go, look, shall we change, depending on consumer trends, shall we change things? What are we going to add? What are we going to take away? Essentially, it's around 2 years old. So it's not by the actual data, but it's the types of goods in that basket. I mean, to me, that's crazy. 2 years old. I mean, you know, with the, with the internet now, 2 months, there's going to be a brand new product. It's just like, it's crazy, but it is what it is. So just to give you an example, CPI data in 2016 and 17 was actually based on data from 2013 and 14. and it's just the way it goes. There are 24,000 consumers that provide information each quarter. 12,000 consumers kept a 2-week diary on frequency of purchased products such as food and personal care. Okay, and this is crazy. 200 categories arranged into 8 major groups. So you can see that, forget the pint of milk and the newspaper. It's a little basket. It's not. It's massive, and it's really, they put everything in the pot, and some of it is weighted, some of it it's all split into various weightings. But that's essentially what US inflation is. Okay, so why is inflation important to me, to you, to anybody really? It's important for central banks because it forms a part of their policy. So I'm going to just talk about why it's important to central banks. The Fed, or the FOMC, that means that, when you apply for a job, you get a job description, right? And that means you must do these things, or you're not going to get paid because you're not fulfilling what you're supposed to do, right? In a fancy way, that's what the Fed does. It's called a dual mandate. That means there are 2 things the Fed has to do, and that is create stable prices and maximum employment. That's it. They don't have to do anything else. Now, obviously, they provide liquidity when there's a crash or there's a dollar shortage or whatever it is. Dollars the global reserve, but it has a dual mandate, and essentially, these 2 things, if they do not fulfill them, they're not doing their job. All right. Now, stable prices is inflation. That's it. That's why inflation is super important for central banks. The ECB, can anyone tell me what the ECB, where that's central bank of? I'm sure you'll find it in the, that's it. It's Europe. So that has a single mandate, and that is just stable prices, right? That is CPI. So the ECB has got one job, and that is to create a sustainable CPI of around 2%. Now we'll come to 2% is just something that's been bandied around, plucked out of folklore. It's apparently the Goldilocks, not too hot, not too cold, just right. Okay, I didn't make this up. This is the real deal, right? So you've got 2 massive central banks, probably 2 of the most important central banks in the world, and one of them, half of that is CPI, and the other one is that that's all they do, right? So last July, I think it was around the 7th, the ECB changed their CPI to asymmetric to symmetric. Long story short, right? I've got a little bit of strategic stuff later, but this means that instead of it being lower than 2% and near to 2%, it's lower or higher. So they were basically giving themselves a bit more wiggle room if it goes higher or lower, which is just the case because obviously with energy being sky high, they need that. Okay, so that's why central banks like it. If central banks like it, I like it because I'm going to make a lot of money, right? The second thing, the economy. In around this 2% is the Goldilocks, right? And it's been the standard for quite some time. I would just say, look, it's really, when you get inflation, it's really healthy to get this sweet spot, which I call reflation. So you get, from March 2020 lows, you're going to get like up to 0.2%, up to 0.3% every single month or every single quarter. And that's a kind of a nice reflationary increase. So it's definitely Goldilocks, not too much, not too less, just right. And in around 2% is a nice area. That basically means that, if you're in a situation where, you get a wage increase, or you want to buy a new car or a new house. You don't want crazy inflation, because next week you won't be able to afford it, and then all of a sudden you're going to spend a lot more on the debt you owe. And that's going to cause a lot of problems. So that's why, in the economy, inflation is really, really super important. This is the best bit, traders, right? This is why I like spot effects. Traders, right? If there's a higher CPI, generally the currency goes higher. Why is that? The higher the inflation, the more chance of a central bank, which is point one, is to tighten or raise interest rates to calm inflation, right? What does that mean? It means the currency goes higher. It means I'm buying the currency. It's really simple. With equities, sometimes good news is bad news. So say you're buying, say US CPI comes out, it's 0.5 higher, great. It's a good feeling, so you're buying S&P. But hold on a minute. That means that the central bank is probably going to raise interest rates even more than expected. So that's going to put a cap on S&P. So that good news becomes bad news for your buy on S&P, right? Stuff like that. With currencies, it's a straight line. That's why I like currencies. I like to keep it simple. I've got a simple brain. Currencies tend to fly straight. So yeah, just coming back to trading, if it goes higher, the currency would follow as central banks look to raise interest rates to calm inflation. If it goes lower, central banks may increase QE. QE is quantitative easing. That means they're increasing the purchase of bonds, right? What does that mean? It really calms the yields on all the curve. This is kind of fixed income stuff, but basically if you're buying bonds, the yield goes down. It means everything's cheaper, because the money you borrow is the less yield you have to pay on that borrow, right? And the opposite is true when QT happens, or they raise interest rates. And then the final one, everyone. If you're thinking of buying a car, right, and I love this, and it really hits home. If I want to buy, the latest Tesla, whatever it is, whatever car, if you want to buy a car next week and you think it's going to be much higher next week because you've got some crazy inflation, you're going to buy now and ask questions later. You're going to borrow that money, right? So that puts you in that, cheap money, or that next week's going to be higher, puts you in a place you're going to really demand that product, right? And the opposite is true. If things are going down in price, you're going to hold on, you're going to wait out. And that's why inflation is key to all macro. It's key to all elements, to GDP, right? It affects GDP. It affects wages. It affects the cost of stuff. It affects central bank policy. It permeates into everything from Wall Street to Main Street. That's why it's so important. Okay. As businesses grow, they need to know how much things are going to cost for their business. Are they going to borrow more? Are they going to expand? Look at gas, look at oil, how that's going to affect businesses. It's all part of inflation, and it's constantly moving. There's no sweet spot. 2% is the sweet spot, but it will never remain constant, one place, really. And that's why it's really important. If you can understand 25% of inflation, and hopefully this is going to get you on that rate, you're going to make a lot of money. I mean, I've made a lot of money on just understanding inflation. Okay. So here's a bit of a kind of broader thing, and then I'm going to go through the different types of inflation around here. So, if you think about the cost of stuff in that basket, there's loads of different things. There's, food, beverage, housing, there's clothes, transportation. Oil's a massive thing, and it really affects CPI headline. But you know what? It's not the most important thing in the US. PCE is a type of inflation. It's called PCE or PCE deflator, and it's called the personal consumption expenditure. It's an index of expenditure, and the reason is it's something the Fed watches to shape, to really hone its central bank policy. It really looks at the PCE deflator, and it really focuses on personal consumption. And obviously, America is a land. I used to live in America a couple of times in Los Angeles, and I can tell you for nothing, they love convenience. They love spending consumer goods. They love it. I love it too. We like stuff, right? In America, they really like their stuff, and they like it cheap and convenient, and that's all part of PCE. The other thing I want you to share with you is PPI. Often gets overlooked. It's called the Producer Price Index. And when the PPI comes out, this is inflation at business level. And what it does is basically it's the producer, and this can be a really good indicator for production at very close to business level. If producer prices like the raw materials start spiking, that could be a good indicator for PCE and CPI later on, because PPI comes out first. These two, they're just a kind of FYI. They're not massively important, but I would say go and do your own research and Google them. The IPP and the ECI. Now, the IPP is the International Price Program, and this is inflation for imports and exports. I think it's actually part of GDP, but do your own research. But it's just something, it's just a nice thing to understand. ECI, the Employment Cost Index. This is the inflation specifically for the labour market, which is quite important. Now, this ties in a little bit with earnings and real earnings. Now, in the UK on Wednesday, I was going to take a drink of water, apologies. In the UK, on Wednesday, we had real earnings, which were -1%. Our Chancellor kind of sugarcoated it, saying, yeah, everything's rosy, everything's peachy, but it's not, right? It's not. And that's because of inflation, right? It's fine to get a pay increase of like, £100 a week. But if you can't, if things are like £120, then it's a net, you're getting a decrease in your wages because things are so much more expensive. That's inflation. Okay. Okay, this is going to be fun. These concepts here, I really want you to just have a look at and go away with. Hyperinflation, basically look into Venezuela, Zimbabwe. I have to apologize, my spelling is a little bit ropey on some of these things, but these are crazy types of inflation. It means that you get like 10,000% inflation. Take a look at the US in the 70s. We can sort of learn a bit, and people were saying, oh, we're going to get there. It's very different from the 70s, right? Stagflation. Has anyone heard of stagflation? We're about to get stagflation in the UK. Thank you very much. But basically, stagflation is decreased GDP, so it's stunted growth, more unemployment, and higher prices. That's what stagflation is. Okay, deflation, just look at Japan in the 1990s. That means continue with lower prices, sometimes negative. Reflation is really my favorite. From the March 2020 lows, when we were all in the doldrums, that at that point throughout the entire 2020 and 2021, that's when you get from a low to a high. It's a really nice place to be in. Basically, reflation is something that can't last forever, but it's a really nice place. It's a sweet spot between deflation and inflation, and you can really look at prices post March 2020 for reflation. Disinflation, not really a massive thing, but it's when prices temporarily slows down. So those are the key things to highlight to you. Symmetric, and these are the strategic types of inflations, which are here. You know, the ECB in last year, they had this review of what kind of inflation they want. Asymmetric versus symmetric, fancy word that basically say asymmetric is they want it below 2% or around 2%. Symmetric's a little bit easier because it's above or beyond. And AIT, which is the average inflation target, the Fed did this, I think last year as well in the summer. And basically what that means is they can cook the goose for much longer above and beyond 2.5%. Maybe they saw the higher gas prices. I don't know, but what these two things do is it gives a bit more breathing space for any nasty prints of inflation to happen. And the Fed or the ECB is going to go, actually, well, it all formed part of our new strategy. So that's why these two things have happened. This really, you have to put this into context when you're trading a beat or a miss on inflation. So that's just something to bear in mind. The Fed did that. So let's burn it. Let's cook it over 2.5 to make up for the undershooting. Years and years of undershooting inflation at PCE level. Okay. I'm just conscious of the time because I've got probably 10, 15 minutes. This really is something for you to go away and explore yourself. But there's this echo of inflation in the US compared to 2021, and certainly this year. The big difference really is the 1970s were nothing like today. And the big difference is there were two oil shocks and the gold standard had changed, finished. These were hugely inflationary. The other thing which was being built up in the 60s, which fueled the 70s, was the guns and butter LBJ program, which were buying up tons and tons of things. So those, I just want to get that out there. But these are additional things that, we were living in a very different time. So that's why I don't think we're going to get inflation like we did in the 1970s, just because of those things. So, back then, the US was a closed economy. Imports were at around 3% of GDP. Today, they're 4 times greater. We live also, manufacturing was at 22% back then. That's incredible. And we're now in a, there's no unionized labor. We're now in a very much globalization world. The internet, things are cheaper that way. There's less closed inflationary dangers within, say, the US. So it's a very, very different place to live. So just bear that in mind. And here are some of the dates. The gold standard left. Basically, this meant the US dollar was pegged to gold, which stabilized everything. So yeah, the gold standard was very deflationary. And when that got removed, then this really fueled speculation. Especially the future pits in Chicago were around 72, I think they started, and that really was the mecca of speculation in all assets. So yeah, we can get gleans of wisdom from the 70s, but we're not there. We're not there. And I would just say some of these and finallys, narrow, which is the non-accelerating inflation rate of unemployment. It's a bit of a mouthful. That is actually it's a fancy economic term, and I have to confess I'm not an expert on it, but it's something. Google it, and also the Phillips curve. These are two things the Fed looks at, and a lot of central banks do look at. It's basically the relationship between the rate of inflation and unemployment. There is a curve, a cross curve that comes, and the Fed does watch it. But if it does spike or fall dramatically, it really can set alarm bells for the Fed. So it's just something to bear in mind. Now, some various indicators of inflation that come out way before inflation does. Look out for ISM prices paid, right? This is the rate of change or the acceleration of commodities. Very important, all right? So when ISM comes out once a month, there's two versions. There's manufacturing and non-manufacturing. When that comes out, have a look at the component in that called prices paid. That's really, really important, right? Break evens. This is, in a nutshell, the market's view of inflation, where it's going to be in 5 years, right? There's loads of different durations, but that is where the market is pricing inflation in the future. There is this is more institutional stuff. It's called CPI swaps. Very similar to break evens, but it's just another market perception of where inflation is. It's a good thing to have. It's a good thing to watch. You're going to have Bloomberg for this, but if you Google CPI swaps, you will certainly get some headlines from forexlive.com, which is a free website, or Reuters are pretty good on CPI swaps as well. And this thing everyone was banging on about last year, bottlenecks and base effects. Now I'm sort of, bottlenecks is basically a constriction on supply. So if there's nothing, it's like, I've got a bit of a trainer. I used to have a bit of a trainer for addiction, and I had a whole room for the trainers. I've stopped it now. I've got therapy for it. When I couldn't get a certain type of high top, I used to pay out of the market a lot more. That's what basically, because there was no product and a lot of demand. That's what a bottleneck is. Base effect is like coming from a really putridly weak base and then moving up slightly more, but that change is massive. That's what a base effect is. So I can't believe I've just told you about my trainer addiction. Never mind. But that's basically the best way I can describe a bottleneck and a base effect. There you go. Really important stuff. Do your own research. Just go for it. Really, really good stuff, this. If you can really understand just a fraction of all this, you're going to make a lot of money. Okay. Let's kick this into touch, right? In short, why is the current conflict in Russia and Ukraine going to affect inflation? Well, oil and gas, right? You got Russia just about avoiding a default, but a default is still on the cards, right? If this happens, the central bank, the CBR, has raised interest rates to 20%. It could go to 40%. If that happens, they might also reduce oil production to increase the price to get their money back. That means the government will make a lot more money. And if oil goes up, world inflation goes up. The price of oil really drags the entire tide of inflation up because we all use oil. That's in a nutshell, right? Corn, right? Ukraine's the basket of wheat. It's the center, the basket of wheat to the world, right? That gas, right, to Germany, to Nord Stream, it's all inflationary. When the price really starts buying, look at nickel. The LME, the London Metal Exchange, closed down. It closed down again, I think, recently, because nickel just exploded. That's inflationary, right? It's all important stuff. Here's some quick charts before we get onto the central bank, because I think, I spent a longer time on inflation. We're going to sort of whiz through the central bank section. These charts are from the Wall Street Journal. Look, 20% back in the, this is wartime inflation here. You see my red line. This was the late 70s, around 15%. Some more comparison charts, a bit more close to home. But there you go. 5%, we're just above that in the US. And there you go. This was way back in the 60s. It was really limp there. And then the guns and butter from Lyndon Johnson really exploded it up. It was that fuel in the fire. Some charts there for you. Okay, so this is the unemployment rate. Usually when inflation starts to spike, things cost more, right? So businesses have to cut their staff generally. And look what happened here. This was COVID. Massive, isn't it? Okay, unemployment rate, 15% in the US. Okay, just quickly, here's some bad boy countries on inflation. Look, 2,941% Venezuela, Zimbabwe 51, Comoros, Turkey. Really is, and there's a couple of websites I want to leave with you. Trading Economics, a really great website for kind of half retail, half institutional, and it will really kind of square the circle in your knowledge. Really nice. World government bonds. Okay, if you have a girlfriend or a boyfriend and you have a great social life, don't look at worldgovernmentbonds.com because your social life will get ruined. It's great. So I'm sorry about that. Yeah, that is a great website to have. You can look at yields, you can look at defaults, you can look at CDSs, you can look at their crazy inflations, all that. Okay, so I'm just going to shoot on to the next one. Here's some big numbers for you. Hyperinflation, Venezuela, right? So in 2019, the International Monetary Fund, the IMF, estimated that inflation would reach 10,000%, right? That is just crazy, right? Absolutely crazy. The 10-year yield at 46%. That means if you buy 10-year bonds, you get, after 1 year, 46%. But that 46% is relative of your risk you're taking, right? Turkey, that's an amazing country. I've been there many, many times. That's, I guess, the closest you'll get to some kind of hyperinflation. Not quite there yet, but it's just these things. Just keep them all in mind. Okay, so this is the central bank section. All right, just sort of looking at the time. As you know, central banks have a job description. So mandate, the ECB is a single mandate, and the FSM is a dual mandate. So stable prices, which is inflation, and maximum employment. The Bank of England, it brought in this kind of green mandate as well, but it kind of dovetails into what I said before, really. And that's essentially now with central banks, I would recommend last Wednesday, study it, right? Have a look at what they do. This is a cheat sheet. It's on the internet. It's from InTouch Capital Markets. They're great guys, really, really great guys. Study this. This is from the FOMC, right? So central banks form monetary policy, and part of that is inflation, part of the dual mandate. All these people are on the central banks, and doves and hawks, right? A dove is someone who really favors spending money, having cheap money, reducing interest rates, doing more QE. A hawk is the opposite. A hawk is a bit more kind of, I would say a hawk, not a miser, but a hawk is someone who's a bit more frugal. Someone who's like, okay, let's just, save your money, don't spend, reduce your balance sheet and all that. And essentially in any central bank, you're going to get hawks and doves, and they all battle it out every meeting. And based on what the central bank person, how they're positioned, what they say, you can make a lot of money out of that. If Clarida, let's just say Kashkari says something super hawkish, it's the opposite of what they generally say. and that's your trade. You can really make a lot of money in dollar and risk on those. So yeah, study your central banks, the hawkometer. This bad boy is really important. On Wednesday, this came out, it got released, and these are the expectations and votes of interest rates. So it's essentially get your central bank, and these are the dots, but they're in a nice way. They're not the tree, which I just don't understand. Study this. It gets released every big central bank, and it was on Wednesday. And look at the reaction to dollar on this release. Essentially, if you, and I'll be going to talk about the extra added bonus material, how to trade this. If you open a real account with the wonderful XTB, brilliant opportunity. So really think about that. So I'm going to be talking a bit more about that. But this chart here, you can get from the Federal Reserve up there. There's your link. Okay, it's super interesting stuff. But you know, I've been studying central banks for about 15 years. I still haven't cracked it, but I've made money out of it. You'll never ever always crack it. You know, I have never met. You hear about a bunch of experts, but they've all really always learning. Be curious. Be Sherlock Holmes. Okay, so I'm just going to wrap this up now, but this is I want to give you an opportunity to have a free strategy session with myself. If there's anything in this masterclass you didn't understand, or if you just want to do some troubleshooting, this is the address. Give me, you know, I'll leave it in the chat, in the Q&A. Take this down and book me in. This is my Calendly schedule. I've cleared away the next couple of weeks. So please do book me in, and it's free, right? Absolutely. Please fire off any questions, and I'm going to leave you with this. I have created some really VIP special content for those people wanting a real account, and this is really how to trade, and it's really going into a deeper level on the FOMC, how to trade it, what I look for, how I can be particularly, you know, honing my edge. And you know what? The last Wednesday, there was a massive reaction to dollar and risk on the Fed on Wednesday night, and it was an interesting move. So you'll get more of that if you do take up this amazing opportunity with XTB. So with that in mind, that's me done today. I want to say thank you very much for taking part and listening.
Thank you so much, Patrick. That was amazing. And I'm pleased to hear that you've recovered from your trainer addiction.
I can't believe I said that. Oh.
Well, I'm pleased that you've made it here today, despite everything you've been through with that. Thank you so much for your speech. I do have a question. And then we've got a couple of questions from YouTube. So one thing that you did mention is that you can make a lot of money if you understand inflation. Is that to do with borrowing and leveraging at the right times and then saving at the right times, or is there anything else a bit more complex to that?
No, this speculating on trades, on currencies, but also on equities. So if there's a huge inflation print, generally the central bank will raise or be more inclined to raise interest rates. That will get a massive move on the dollar. Right. And the same with the ECB with euro dollar. So if you can anticipate inflation and how much that will move or shift the needle on central bank policy, that's how you make your money. And I would always say, you know, when a piece of data, inflation, any bit of data comes out, ask yourself, is that enough to change monetary policy? Yes or no? That's your trade.
Okay, brilliant. Thank you so much. And we've got a question from YouTube as well. We've got Rawler has asked, did Russia default on bonds debts yet, or is it coming soon?
No, technically they didn't, because they tried to pay in rubles. JP Morgan accepted that. So good luck with that to convert it. But I would say no, but it's coming. It's going to happen.
Okay.
And I would say, you know, you can only see all of the last banks just getting themselves removed from this risk. So yeah, they're about to default.
And then what happens if and when that happens?
Well, the lawyers swoop in, the vultures go in and pick through the bones, basically, and they come to an agreement, and that's usually defined as some kind of haircut. Now, a haircut is an agreement through the CDS structure, usually is to say, look, all the people that want their money line up, because some are more important than others, line up and say, well, how much are you prepared to receive? And usually they'll price that through the CDS and go, look, okay, is that a 35 cents to the dollar? You can accept that, or you can accept nothing if you want. And it's their reaction, really. But yeah, it's the key thing about Russia, Caroline, is Russia. I mean, the reason PIMCO, JP Morgan, Stanchart, UBS, the reason they're all hurting, the reason they're all bleating. Look at BlackRock. They lost, what, 14 billion, right? The reason they're all bleating, because Russia was a really good story, macro-wise. Their macro was pristine before all this happened. That's why every single investment bank and hedge fund that wanted to go knees deep in risk, that's why they got involved.
Okay, we have another question from YouTube. We've got Powell has asked, do you think investment in tech companies is a good idea at the moment?
Well, it was in 2021, because you had this growth. You know, essentially, I like to keep it. You know, I do think I've got a simple brain, and I like to keep it simple. And I would say, you know, when we're in COVID, you're on Facebook, you're on Netflix, you're on Deliveroo. You know, you're all of these like convenient things that, you know, you replace. So yeah, growth over value. Now you'll find that that's really, really unwound. I would probably, tech stuff is inherently more risky. Hedge it out with some staples, some value, and just, you know, hedge it out with some long-term bonds, you know, if you want. But yeah, I mean, expect a bumpy ride for tech stocks, definitely, because let's not forget, we're in an interest rate hike cycle, and the Fed's business as usual, right? That's going to hurt tech stocks. They're going to be the front row seat on being hurt.
Yeah, I think so. We've got the same person has said that there's been a bit of a correction in the tech stock. So does that make it a good time to buy? But I think you've kind of already answered that, haven't you?
Look, you know, if it's attractive, if you've got all the fundamentals in that particular stock, great, right? It's always but don't lump in everything. You know, I would just say, look, bear in mind, you have got an interest rate hike cycle up to around 2% on the base. So you've got to factor that in as well. But yeah, I mean, nibble in buying dips, that's fine. I mean, you know, it's all healthy stuff, but just make sure you've got a well-balanced portfolio and you're not going all in on like Netflix or all in on any other of the fangs. It's like, you know, just common sense.
Brilliant. We've got one last question come through for you. What do you think would happen to the prices of crude oil and natural gas if Russia defaults?
Yeah, it's a really good question. Thanks. Yeah, I'm going to try and
Everyone
find
wants to know where to put their money.
Yeah, I mean, in a weird way, I just think it all depends on Europe's reliance. Now, about 2 weeks ago, the Europeans had a crisis meeting, finding alternatives. Europe, especially Germany, the reliance on Russian gas is about 45%. They have targets for winter for that to be 15%. So that's starting to get priced in a little bit. It is a very optimistic target. One thing I will say is the oil and gas price will probably get more volatile. I wouldn't say it will shoot higher immediately. It'll just be a lot more choppy because we're in a very different place. As what Jaime said, my predecessor, the first splash, the first invasion, the first bomb to go off, the first kind of force or shock is the biggest, and the rest of them are less so.
Do you have one more question in you?
Yeah.
We're coming in at the end now.
Yeah, no. I'm. Just try and stop me talking about markets.
I will in a minute, but at the moment we've got questions coming
in.
Yeah,
no worries. Anything.
Powell has asked, interest rates are still lower than inflation. If markets realise that, can it cause another surge?
Yeah, I mean, okay, so interest rates have been low for far too long, right? So now that is changing, but we're still like at nothing, right? I've been around a long time, right? Interest rates, and I doubt they'll get more than 2%, right? So I would say the best way to answer your question is look at the big events and the reaction function of dollar and risk. When I say dollar, I mean the US dollar. When I say risk, I mean equities. Look at what happened on Wednesday, right? The reaction to the Fed being really hawkish was nothing. So this is super interesting, and it's really, really important that the market is not taking the Fed seriously, right? And the Fed was super hawkish. It was a hawkish hike. They're super hawkish, unlike the Bank of England. The market doesn't want to know. Dollar's going lower, risk is going higher. Aussie, CAD going higher, equities had a bounce. So this is important. So at what point do the markets realize? I'm not sure. It could go on a little bit longer, but at the moment, the markets are discounting, war to be anything other than local, and they're discounting the Fed actually getting real and going on a path of rate hikes and balance sheet reduction. I think that's wrong, but price is king. Price is right.
So it looks like everyone wants you to keep talking about interest rates. I promise this is the last one.
Yeah, no, absolutely.
How about food producers? Are they good in high inflation environments?
Yes and no. I mean, having more, it depends on what their costs are. So it's like, if the net cost for producer price index and everything goes higher, then net, they're not making more money. Obviously, if they're passing it on to the consumer or the next producer, depending on if you're a farmer and you're passing it on to the baker, or the butcher, if you're a livestock farmer, then fine. But where's the profit? It needs to be a net difference. So yes and no is the answer to that. One thing I will say is everyone's really agreed that this 2% mark is a Goldilocks percent in inflation, and where we're at now is not a good place, and it's not sustainable.
Thank you so much, Patrick. You've been very informative as always, and I hope that you enjoy the rest of your weekend.
Thank you very much.
Thank you.
Thank you.
So we are now at the end of the event. And first of all, I'd just like to thank all of the participants. So I'd like to thank Stephen. I'd like to thank Walid, Jaime, Patrick, and the roundtable guests, so Anika, Timothy, and Poku Banks. And also there have been people who've been working tirelessly for months who you perhaps haven't seen today. So thank you, Wanda. Thank you, Mark. Thank you, Jason. Thank you, Josh. Thank you, Sarah. And thank you, Simon. So just a reminder that all of the speeches will be available on the XTB platform. And the speakers have also prepared exclusive bonus content, which is available to all the XTB account holders. So please don't hesitate to get in touch with XTB to learn more about this offer. And I hope you are feeling so much wiser and more educated after today. I know that I am. It has been such a privilege to be part of it. And I hope you have an amazing rest of your day. Goodbye.
Successful manager, smart investor, nice guy. Who do you want to be? You want to have the knowledge and intuition that always gives you the advantage. Do you want to have at your fingertips access to the latest technology that lets you be one step or even a few steps ahead? To have stories of all of your victories and defeats, but always take lessons on how to improve. To feel the emotions, the excitement, because in the end, you see your strategy is working. Do you want to be like me? You can when you trade with XTB.